talking about your input tax credit, you need to understand that there are various sections, right? Starting from section 16, but the main sections are your section 16 and 17, which tells when to take credit, when not to take credit, and how much to take credit. There is a concept of proportionate credit also. Then section 18, which is very special cases. ITC in special circumstances. Something is happening, one-time situation. It is not a recurring situation. It will not be a recurring situation. 19, 20, 21 talks about very special case, job worker and input service distributor. Now, government after all has to be government. So government tells that when you're claiming ITC, you have to prove that the ITC is eligible. The burden of proof lies on you, which means our departmental officer can any point of time tell that the credit that you have taken is ineligible. Section 155 is drafted in such a way that if you are taking the credit, the burden is on you to prove that it is eligible. Right? It is as if you're talking about a scenario where the police is telling that you have committed the murder. Now you prove that you did not commit the murder. It's just similar to that. So if you are taking credit, we can doubt at any point of time. You have to prove that the credit that you have taken is eligible. Now when you talk about your ITC certain terms, one thing you have to keep in your mind very clearly. Input tax credit means you are talking about inward supply, inward supply, inward supply, inward supply, inward supply. In simple language, you are talking about your purchases, expenses and fixed assets. You should not think of sales. You should not mix your output tax and input tax credit. So when you are talking about your supply, when you are talking about your output supply payment and all, it's all your sales or outward supply. It is all about inward supply. Now, inward supply of what? Either inputs or capital goods or input services. So your inward supply, purchases end or expenses end or assets end, can be either goods or services. If it is goods, how to know whether it is inputs or capital goods? Very simple way. Inputs means anything other than capital goods. In accounting language, these goods are going to your manufacturing account, trading account and profit and loss account. What is capital goods? Capital goods means the goods which have been capitalized in your books of accounts, which means they are going to your balance sheet. They are going to your balance sheet. And what do you mean by input service? Now for input service, they tell that no differentiation. Whether that input service goes to manufacturing account or trading account or profit and loss account, or it goes to balance sheet. Certain input services will be capitalized. No difference. It is going to be called as input service, any service. So for goods, there is a differentiation. What you are taking to your manufacturing account, trading account, profit and loss account, inputs. What you are taking to your balance sheet, fixed assets, that is capital goods. For services, whether you take to your manufacturing, trading, profit and loss account, or whether you take to your balance sheet, you will capitalize a lot of services. Say for example, your purchase plant and machinery, that is capital goods. You are installing that plant and machinery, that is the service, installation service. But that is also being capitalized. It is input service. It is input service. And that's one common point, whether it is inputs, input service or capital goods. It should be used or intended to be used in course or furtherance of business. You just cannot take the credit of any item. It should be used or intended to be used in course or furtherance of business. In simple language, it should have business connection. It should have business connection, either present or futuristic. Either present or futuristics. Used or intended to be used. In course, which means while doing the business or furtherance of business. Even you can take the credit of R&D expenses, research and development expenses, which will not give you any business today, but it might give you business in future. Right? So inputs, input service and capital goods. And all these three inputs, input service, capital goods will be inward supply or outward supply. Will be all inward supply. So what do you mean by inward supply? Inward supply means receipt or supply. Are you receiving or are you giving it? Inward supply means are you receiving or are you giving it? Receipt of goods or services. It can be by way of purchase or by acquisition or any other means. You can get them free of cost. With consideration or without consideration. It may be with consideration or without consideration. Tamil Nadu branch is sending goods to Karnataka branch. Tamil Nadu branch will pay output tax. Can Karnataka branch take input tax credit? Yes. Has it purchased? No. Acquisition? No. Any other means? Yes. With consideration? No. Without consideration. Without consideration. Inward supply. Inward supply. So that is inward supply of inputs, input source and capital goods. And see, outward supply is used in a different context. So you may ask why outward supply is used. Now let us understand the significance of using outward supply here. By the way, outward supply is nothing but your supply. Outward supply is nothing but your sales side. Whatever you discuss in supply, the same thing is given here. Outward supply focuses on supply of goods or services. It may be by way of sale, transfer, disposal, barter, exchange, license, lease, rental, same thing, which are agreed to be made by a person in course or furtherance of business. Same thing. So why are we focusing on outward supply? Just now you said that when it's all about input tax credit, focus on your inward supply. Suddenly you're telling that focus on. No, it is not like that. Normally the end is always inward supply. End is always inward supply. Now why it is outward supply is given is, if you are not paying output tax on your outward supply, you cannot get input tax credit on your inward supply. If you are paying output tax on your outward supply, you can get input tax credit on your inward supply. So that is the logic of ITC. We'll be seeing it further. If you know output tax, don't take credit. Schools, colleges, don't pay output tax. Can they take credit? No, they'll have a lot of expenses having GST, but then can they take credit? No. It is going to get added to their cost. If you're paying output tax, you get credit. But there are certain special cases like zero rated supply, which is technically nothing but export of goods or services, or supply of goods or services to special economic zone. Export of goods or services or supply of goods or services to special economic zone. Now, when you talk about such cases, that you are talking about export of goods or services or supply of goods or services to SEZ, they are technically called as zero rated supply. Zero rated is different from nil rate, correct? So zero rated supply. What is the significance of zero rated supply? Normally, what is the thumb rule? No output tax, no input tax credit, correct? Don't pay output tax on your output supply, no input tax credit on your input supply. Pay output tax on your output supply, get input tax credit on your inward supply. But for zero rated supply, it acts as an exception. Even if you are not paying output tax on your outward supply, which is zero rated supply, even then you can take input tax credit. Not only that, you can also take the refund of it. Not only you can claim the credit, but also take the refund of it. That is the reason why outward supply is given. So what is the thumb rule? You're not paying output tax on your outward supply. Can you take input tax credit on your inward supply? No credit. If you're paying output tax on your outward supply, take input tax credit on your inward supply. Exception. When you talk about zero rated supply, even if you're not paying output tax on your zero rated outward supply, still you can take credit, input tax credit on your inward supply. Not only you can take credit, you can also apply for refund. You can also apply for your refund. Now, that is the significance of outward supply. Now, let us focus back again on your inward supply. Inward supply of inputs, input services and capital goods. Now, you need to understand that there's a difference between input tax and input tax credit. Please understand that any tax on your inward supply is input tax. If you can take the credit, it becomes input tax credit. If you're not eligible to take the credit, it gets added to your cost. Any tax on your purchase invoice, expenses invoice or asset invoice is input tax. You can take the credit, it becomes input tax credit. There is high possibility. Say for example, if you purchase motor vehicles for passengers, is there input tax on your purchase of motor vehicles? Yes. But can you take the credit? No. So there is input tax on purchase of motor vehicle for passengers. But can you take the credit? No. It gets added to your cost. So you need to differentiate your input tax and input tax credit. Input tax credit is very simple. Input tax credit means credit of input tax. If you are allowed the credit of input tax, that is input tax credit. If you are allowed the credit of input tax, that is input tax credit. If you can take the credit, welcome to the world of input tax credit. If you cannot take the credit, it gets added to the cost. I'll again repeat this simple thing. You have purchased motor vehicle for passengers for your business. On that purchase, whether there will be input tax, whether there will be GST? Yes. Is it your input tax? Yes. But can you take the credit? No. So that is input tax, but it is not input tax credit. It gets added to your cost. It gets added to your cost. Now, input tax means what? Input tax means any tax. A supplier, if I'm purchasing from you all, what all taxes you can charge? You can charge either CGST or SGST or IGST. Whenever I purchase, supposing I'm in Tamil Nadu, you're also in Tamil Nadu. If I purchase from you, you'll charge CGST, SGST. Can I take the credit of it? For you, it is output tax because you're selling it. For me, it is input tax. If I can take the credit, it becomes input tax credit. I'm purchasing from Maharashtra. I'm in Tamil Nadu. I'm purchasing from Maharashtra. What are you going to charge? IGST. For you, it is output tax. For me, it is input tax. If I can take the credit, then it is input tax credit. If I cannot take the credit, that is the input tax, but it is added to the cost. It is added to the cost. Right. So it is tax charged. Can I import goods? Can I import goods? Yes. If I am importing goods, what will be the tax? Remember that. If I am importing goods, what will be the tax? No. If I am importing goods, what will be the tax? Custom duty. The breakup of which is basic custom duty, SWS plus IGST, BCD plus SWS plus. I can take the credit only on IGST portion. Can I take the credit on your BCD portion? No. Can I take the credit on your SWS portion? No. Again, it is a classic example where it is input tax, but I cannot take the credit. I cannot take the credit. On what I can take the credit? Only on IGST portion. I repeat, when you are importing goods, what is the tax? It is not GST, it is customs duty. Breakup of which is BCD plus SWS plus IGST. BCD, SWS, I cannot take the credit, it gets added to the cost. IGST, I can take the credit. Second question. If at all I am telling that it is supposing I am purchasing something which is under RCM. RCM is input tax or output tax? If I am paying RCM, if you have supplied to me, if I am paying RCM, is it input tax or output tax? RCM is input tax. RCM is paid by recipient. Recipient is always receiving it. Inward supply. So RCM is what? RCM is what? Input tax. And we have discussed this. RCM always pay by one hand, cash ledger, then get the credit in other hand, credit ledger. First pay by cash, then get in credit. First pay by cash, then get in credit. Clear? So your RCM is what? It is not output tax. It is input tax. It is not output tax. It is input tax. So first what you will do? You will pay it by cash. See, you are the supplier, I am the recipient. I am paying RCM. Normally, you will collect tax from me, but in RCM case, I will pay RCM. The fact is, it is still my inward supply. It is not my outward supply. You have sold, I have purchased. It is still my inward supply. I will pay tax under RCM, then I will take the credit. I will pay by cash ledger, I will take the credit in credit ledger. It will happen in the same month. Pay by cash ledger, take in credit ledger. It will happen in the same month. But first I have to pay by cash. Then I will get in credit ledger. Rather, in payment chapter, we have discussed this. There are certain things where you cannot pay by credit ledger. In that list, there was interest, penalty, late fees, any other payment, composition tax, TDS, TCS, and RCM. RCM is not output tax payable, it is input tax. Pay by cash first, and if you are eligible for credit, get in credit ledger. If you are not eligible for credit, you pay by cash, it becomes your cost. It becomes your cost. 99% you'll pay by cash and get in credit ledger. But if you're not eligible, you'll pay by cash, but you will not get in credit ledger. So what is input tax? Supplier charging CGST, HGST, or supplier charging IGST. If I'm importing goods, BCD, SWS is not input tax, but IGST is input tax. If I'm paying under RCM, RCM is input tax. I'll pay by cash, I'll get the credit in credit ledger. Now, finally, what is not included in input tax? And this is very clear when we are seeing composition scheme. If I am purchasing from you, if you are under composition scheme dealer, I am not under composition scheme. I am purchasing from you, you are under composition scheme. You are under composition scheme. What is the document that you will give? Bill of supply. Can you collect tax from me? Can you collect tax from me? As a composition scheme dealer, you have to pay 1%, 5% or 6% from your pocket. Can you collect tax from me? On your bill of supply, whether there will be any tax? No. Can I take credit? No. As a composition scheme dealer, you cannot take credit, you cannot collect tax. Also, if I am purchasing from you, I cannot take credit. Why? You have given me bill of supply. On that bill of supply, there will be no tax. Why? As a composition scheme dealer, you cannot collect tax from your customer. You have to pay from your pocket. So if I see the purchase invoice, I will not find any GST. I will not find any GST. So is it my input tax? No. The opposite person has paid the tax, but he has paid from his pocket. I don't find it in my bill of supply. I cannot take the credit. I cannot take the credit. Right. So that is all about your input tax. It includes IGST on import of goods. It includes RCM, but it excludes composition tax. It excludes. We are not talking about a composition scheme dealer. For a composition scheme dealer, this chapter is totally irrelevant. Why? A composition scheme dealer cannot take any. So we are not talking about him. We are talking about a person who has purchased from composition scheme dealer. And if I can take the credit, that is input tax on my purchase invoice, expenses invoice or asset invoice. If I can take the credit, it is input tax credit. If I cannot take the credit, it is added to my cost. And in input tax, you need to understand that there are two steps. First, take the credit, then use the credit. First, take the credit, then for taking the credit, there are certain conditions, including time limit. For using the credit, there is no condition. There is a restriction. There is a sequence for using the credit. There is a sequence for using the credit. And once I take the credit in time, I can use it at any point of time. After 1 year, after 10 years, after 15 years, after 30 years. There is no time limit. What is the time limit? There are two different things. Availment and utilization. Availing is getting the credit. For getting the credit, there are a lot of conditions. There are a lot of conditions. And when you satisfy the conditions, you will get the credit. One of the condition is time limit. One of the condition is, so you have to take in time. But for using the credit, there are no conditions. There is a sequence. You have to follow the sequence. Is there any time limit for using the credit? If I have taken the credit in time, I can use it in the same month, next year, after 10 years, after 15 years, after 30 years, I can use it at any point of time. So you have to be very clear, there are two steps. Availment of credit, first take it, then use it. For availing, things are different. For utilization, things are different. Right? This is not part of definition. This is the understanding of input tax credit. Availing the credit and using the credit. And who can take the credit? Only a registered person can take the credit. What do you mean by registered person? Very simple definition. Registered person means who's having GST-IN. Who's having GST-IN under section 25. But registered person will not include person who are having UIN, international bodies. Only if you have GST-IN, GST identification number, you are called as registered person. If you are having UIN, who will have UIN? International bodies. International, they are not registered person. Though they have something in GST, but they will not be called as registered person. They have UIN. They have done something in GST. They have taken some number in GST, but they are technically not registered person. Now, once you have this background, very easy to see the conditions. Be with me. We'll be seeing about 11 conditions to understand when you can take the credit. When you can take the credit. First condition is you should be a registered person. First condition is you should be. If you are unregistered person, can you take the credit? No. At the time of inward supply, you should be. For payment, it's not so. For output tax payable, you should be taxable person. Whether you are registered or not, you have to make the payment. See, things are different. For your output tax, you should be taxable person. Either registered or liable for registration. Either registered or liable for, even if you are not registered, you are liable to pay output tax. But for input tax credit, you should be registered person. You should be registered person. Condition number 1 is registered person. You should be registered person. Unregistered person cannot take the credit. Condition number 2, you should be using that in course or furtherance of business. Those inward supply should be used or intended to be used in course or furtherance of business. Business connection. Business connection. First is registered person. Second is business connection. Business connection. Third, you should have proper documentation. You should have proper documentation. You should receive the document. You should receive the proper document. Now, what are the documents for that on basis of which you can take the credit? It is either tax invoice or supplementary invoice, debit note. Supplier will pay extra output tax, recipient can take extra input tax credit. Either tax invoice or supplementary invoice called as debit note. Called as debit note. Or self invoice. Self invoice is nothing but recipient himself recreating an invoice. Normally, invoices of other person. Self invoice is recipient himself is making invoice. Self invoice is applicable when? Self invoice is applicable in a case where supplier is unregistered person and it is a case covered under RCM. If supplier is unregistered person, can he give GST tax invoice? No. And it is under RCM. Recipient himself has to pay RCM first paid by cash ledger, then get it in credit ledger. First paid by cash ledger, first make the payment, then get it in credit ledger. So he has to have a self invoice. Self invoice is nothing but a tax invoice, but created by recipient himself. Normally, when you are talking about document, you talk about what document? Document of supplier, opposite party. Document of supplier, which is opposite party. But here, what is happening? I am taking the credit based on my own document. When supplier is unregistered and it is a case covered under RCM. And it is a case covered under RCM. I have to create self invoice. Both the conditions. Supplier is unregistered and it is a case covered under RCM. If it is not covered under RCM, I need not create self invoice. Supplier is unregistered and it is a case covered under RCM. I will create self invoice. Next, if I am importing the goods, for import of goods, the document is bill of entry. Import of goods will attract what taxes? Custom duty. Breakup of which is BCD, SWS, IGST. I cannot take the credit of BCD and SWS. I can take the credit only of, for that, what is the document? Bill of entry. For that, what is the document? Bill of entry. And at times, my head office will give me the credit. Reliance Limited will have multiple registration throughout India. They will have a lot of common input services. Where Reliance Limited head office, which is technically input service distributor, will take the credit. Like advertisement service or audit service. And it will distribute the credit to the different GSC number. To the different. Now, who is giving the credit? Head office. Technically called as input service distributor. Now, we are not talking about person who is giving the credit. We are talking about the branch offices. We are talking about the branch offices are taking the credit on the basis of what? Head office invoice. On the basis of ISD invoice. ISD invoice. So, what are all the documents on the basis of which you can take the credit? Tax invoice or supplementary invoice. Basic documents. These are all general documents. Special documents. Self invoice when? Supplier is unregistered but plus RCM. Then bill of entry when? Import of goods. Then ISD document when? Head office giving the credit to branch offices. All these three are very special cases. Very, very special cases. Now, please understand that the third condition is document. When you talk about the third condition, it is important to know that you should have, the supplier is required to put a lot of information on invoice. As a recipient, should I be worried that supplier has put all the details on the invoice? No. If I am taking the credit, for me, I should check only the main contents. What are the main contents? Whether supplier's GST, supposing I am the recipient, whether supplier GST number is there and whether my GST number is there. Throughout the chapter, I will be the recipient. You guys will be the supplier. So whether your GST number is there and whether my GST number is there. Whether description is given of goods and services. Whether value is given. Whether tax is given. Whether place of supply is given in case of interstate supply. I need to verify only these 5 details. Your GST number, my GST number. Description, value, tax, place of supply in case of interstate supply. If these 5 main elements are there on your tax invoice or debit note, I can enjoy the credit. I can enjoy the credit. I will not be worried about even signature. I will not be worried whether you put your HSN number properly or not. I will not be worried whether you put quantity properly or not. I'll not be worried whether you put my address properly or not. All I will worry is 5 important contents. Your GST number, my GST number. Description, value, tax, and place of supply in case of interstate supply. Place of supply in case of interstate supply. You might not have put other details. That is your mistake. You please take action against supplier. What is my mistake? I will enjoy input tax credit. I should check 5 main contents. I should check 5 main contents. That is sufficient for me to take the credit. Right. What are the 3 conditions that we have discussed? Recipient should be registered person for taking the credit. I should be using these input source capital goods used in or intended to be used in course of furtherance of business. I should be receiving the document. I should be receiving the goods or services. I should be 4th condition. I should be receiving the goods or services. I should get the goods or get the services. I should be receiving the goods or services. If I don't get the goods or services, I cannot take the credit. I can take the credit only if I receive the document plus goods services. If I receive the document in April, I receive the goods and services in May. Technically, when I can take the credit? May, when I satisfy both the conditions. If I receive the invoice on 30th of April, if I receive the goods and services on 2nd of May, when can I take the credit? 2nd of May. 2nd of May. Are you guys clear with this understanding? I should satisfy all the conditions together. Receiving the document alone is not sufficient. And I say ask these questions. That one of the input supply, the question will be from the angle of April. The question will be calculating input tax credit for April. One of the inward supply, you have received the document on 30th April, but you have received the goods or services on 2nd of May. So whether that amount will come while calculating input tax credit in April? No. Because you are technically eligible to take the credit only in the month of May. So while writing the explanation, against that inward supply, you should write amount as 0. Why? You are calculating the credit for April month. And for that item, you are eligible for credit only in May month. Clear? I have to receive the document plus I have to receive the goods and services. Now, there are 2.2 exceptions for this receipt of goods and services. Exception number A and exception number B. Now, first exception is beneficial. Supposing you are the supplier, I am the recipient. I am telling that you don't send me the goods, you send the goods to my job worker. I am asking you, don't send me the goods, send the goods to my maybe job worker or customer, whosoever it is. So you are going to give the bill to me, but you are going to ship to third party. You don't know who is he. I know who is he, but you don't know who is he. He might be my job worker or customer, anything. Bill to me, recipient, but ship to third party. As a supplier, you have bill to me, recipient, but ship to third party. Who can take the credit? Recipient or third party? Recipient or third party? Louder. I can take the credit. I am going to make the payment to you. I am the recipient. I can take the credit. But did I receive the goods services? No. Then in that case, receipt of goods or services by third party is equal to receipt of goods or services by me. So when the third party is receiving the goods or services, it is equal to I am receiving the goods and services because he is receiving on my behalf. So receipt of goods or services by third party, receipt of goods or services by third party is equal to receipt of goods or services by me. I can take the credit. I can take the credit. Physically, I have not received the goods or services. Who has received it? Third party. But he has received it on my behalf. So receipt of goods or services by third party is equal to receipt of goods or services by me, recipient, registered recipient. I can enjoy the credit. I can enjoy the credit. This is a beneficial provision. Now, there is a dangerous provision. What is this dangerous provision? In case the goods are received in lots. Supposing you are the supplier, I am the recipient. Through this chapter, you will be supplier, I am the recipient. You are sending me the goods in lots. Against one invoice, 10 crores plus GST, you are sending the goods in lots. 1 crore lot, second 1 crore, third 1 crore, fourth 1 crore. You are sending in 10 lots. Invoices of 10 crore plus GST, but you are sending that in 10 lots. 1 crore plus 1 crore, next truck 1 crore. After 10 days, another truck 1 crore. So after 10 days, another truck 1 crore. When I can take the credit? I can take the credit only on receipt of last lot or last installment. I have received the invoice. I might have received the invoice in April. Supposing you have started sending the lots in April and you're sending the last lot in Jan. You're sending the last lot in Jan. Right, 10 months. Every month you're sending one lot. Invoice I've got in the month of April itself. Invoice I've got in the month of, but can I take the credit? No. I cannot even take the credit proportionately. As I've received 1 crore lot, can I take proportionate credit? No. Even proportionate credit is not allowed. When I receive the entire lots, last lot, I can take the full credit. Because if I don't tell this, your mind will tell that, sir, I've received 1 crore plus 1 crore, then 1 crore. Can I take the credit proportionately? No. It is received against the same single invoice. So I have to wait till I receive the last lot. But the irony is, supplier would have paid the entire output tax. You guys would have paid the entire output tax in the month of April. April means your due date will be 20th May. April written on or before 20th May. But I can take the credit only in the month of Jan of next calendar year. Jan of next calendar year. Right. For you, your time of supply will be April. For me, I am eligible for credit in January of next calendar year. So government treats separately supplier and recipient. Government takes output tax. Well, in the beginning, entire 10 crores. Output tax will be paid somewhere in the month of April. An entire 10 crores. Input tax credit I can take. 10 crores is the value. GST will be on 10 crores. So if it is 5%, 10 crores multiplied by 5%. 10 crores multiplied by 5%. 50 lakhs. So that 50 lakhs output tax will pay in April. But input tax credit I can take only in Jan of next calendar year. Your output tax is dependent on your time of supply. But my input tax credit is dependent on the provisions of ITC. So I can take it only in the last lot or installment. Please understand the first point, beneficial point is applicable both for goods and services. The disadvantageous point is only for goods. For services in lots, I can take the credit in the beginning itself. When I receive the invoice, I can take the credit because it is intangible. Only for goods, I have to wait till last lot or last installment. Beneficial provision is applicable both for goods and services. See, what is the simple summary of this? If I receive the goods services, I can take the credit. Receipt of goods services by third person is equal to receipt of goods services by me. I can take the credit, both for goods and services. But when you talk about goods, if I'm receiving the goods in lots against a single invoice, only when I receive the last lot installment, it is equal to receipt of goods. I can take the credit only at that point of time. But this is applicable only and only for goods, not for services. So that is this fourth condition. Fifth condition, I have to file my return for taking the credit. I have to file my GSTR 3B, not supplier's GSTR 3B, my GSTR 3B. I will get the credit only when I file my return under section 39, that is GSTR 3B. I will not get the credit otherwise. I have to file my return. I can have 100 crore rupees as credit in my books of accounts. But if I am not filing my return, I will not get the credit. For me to get the credit, I should get in electronic credit ledger. And how will I get the credit in electronic credit ledger? By filing my return. As per my books, my eligible credit is 10 crores. But is that the credit as per GST law? No. My books will have 10 crores credit and all. Forget about it. How much credit I will have in my electronic credit ledger? Only that amount which I filed in my return. So I have to file my return for my credit to be appearing in electronic credit ledger. Government will recognize your input tax credit. What is there in your electronic credit ledger? So there are two credits available. One in my books, one in my credit ledger. GST law focuses on what? Books credit or credit ledger credit? How will I get the credit in credit ledger? By filing my return. If I don't file my return, I will not get the credit. That is condition number 5. What are the 5 conditions that we have discussed? Registered business, document, goods services, return. Registered business, document, goods, services, return. Just remember the keywords. Sixth condition, I cannot claim depreciation on GST portion. I cannot claim depreciation on, now people read this in a very incorrect way. It is not telling that I cannot claim depreciation. I can claim depreciation, but only the basic price. Supposing my machinery cost is 10 crore plus 1 crore 80 lakhs GST. 10 crore plus 1 crore 80 lakhs GST. That is 18%. I can claim depreciation on 10 crores. On 1 crore 80 lakhs, either I claim depreciation or I take credit. Can I claim depreciation? Yes. They are not talking about basic price 10 crores. 10 crores, obviously I will claim depreciation. They are only talking about GST portion. They are only talking about on GST portion 1 crore 80 lakh, either I treat it as cost and claim depreciation, or I don't treat it as cost. Even in my books of accounts, I take it under credit and I claim credit. It cannot be both my cost and credit. See, on my input tax, there are only two options. Either it becomes my credit or it is added to my cost. I cannot enjoy both. I cannot enjoy both. So on 1 crore 80 lakhs, if I am claiming depreciation, which means in total I am claiming depreciation on 11 crore 80 lakhs. 10 crores anyways I am going to claim depreciation. If I am claiming depreciation on 10 crore plus 1 crore 80 lakhs, totally 11 crore 80 lakhs, I will not get the credit. But if I am claiming depreciation only on 10 crores, the basic price, 10 crores, I am not claiming depreciation on 1 crore 80 lakhs. Can I take the credit? Yes. Now, this is read very confusingly that for those, if I want to take credit on capital goods, I should not claim depreciation. Absurd. On capital goods, obviously you claim depreciation. What is the point? On capital goods, on basic price, you always claim the depreciation. On GST portion, if you treat it as cost and claim depreciation, no input tax credit. If you don't treat it as cost and you even in your books of accounts you take under credit head, that is current assets, you can claim the credit even in GST. You don't treat it as cost. You don't treat it as cost even in your books of accounts and income tax. Next, there's a time limit for you to take the credit, and this time limit is same in your 3 chapters: return filing chapter, document chapter, credit note, and ITC chapter. Same time limit: return filing, rectification of return, credit note. That's a time limit for you to give credit note, beyond which you cannot give credit note, and claiming ITC. Claiming ITC. What is this time limit? This is same in 3 chapters: return filing, rectification of return, document, credit note, and ITC. Same time limit. Very important time limit. What is the last date for me to take the credit? If I have missed the credit of financial year 24-25, 24-25, can I take the credit in 25-26? Yes. What is the last date? 30th November of next financial year. So if at all I am talking about financial year 24-25, what is the last date? 30th November 2025, or actual date of filing of annual return. Assume I have filed annual return on 25th October 2025. So what is the last date? 25th October. 25th. By the way, this last date means within this last date I should get the credit in my credit ledger. So what is the last date now in this example? 30th November 2025, or annual return for that financial year. Annual return for which financial year? 24-25, which I filed on 25th October 2025. So which is earlier? Which is earlier? Which I filed on 25th October 2025. So which is earlier? 25th October is earlier. What is the last return in which I can take the credit? Can I take the credit in October return? No, because October return will be filed in November. Can I take the credit in September return? Yes, September 2025 I can take the credit, but that should be filed on or before? On or before 25th October. So when I write here 25th October 2025, please understand that my last return is September 25 return. I can take the credit in April 25, May 25, June 25, July 25, August 25, September 25, any of these return, next year returns. But these should be filed on or before 25th October 2025. But what if I tell that, no, I have filed my annual return for financial year 24-25 on 10th December 2025. Actually, ideally speaking, you should never file your return before 30th November if you understand the provision. You keep everything ready, but never ever file your return on or before 30th November, because if there are any mistakes, you could have rectified. But because you are very eager and no, I've done my work fast, very fast, I'll file my annual return. Useless fellow. You have filed in haste. You could have waited. You could keep everything ready, but file it after. So file in that 1 month gap. The last date to file annual return is 31st December. After 30th November, but before 31st December, you file it. Why? What is the advantage? In this scenario, what is the last date in which you can take the credit, or you can raise the credit note, or you can rectify your return? Because all the three, it's the same due date. What is the last date? 30th November now, because whichever is earliest, 30th November. What is the advantage? This we are talking about mistake committed in financial year 24-25. It can be April 24 or March 25 for any of the months. ITC could have been missed of April 24 or May 24 or June, July, till March 25. Any month in that financial year, end date is the same. End date is the same. 30th November of next financial year or actual date of annual return of that financial year, whichever is earlier. So what is the last date now? 30th November. When I tell the last date is 30th November, what is the significance? Significance is I can correct this. The last return in which I can correct it is October 2025 return, which is to be filed before 30th November 2025. I can file returns late, right? And it is always advisable that October return, even if you file late, no problem. Thoroughly check and file it. Thoroughly check and file it. Can I correct it in April 25 return? Yes. May 25 next year. These are all next year returns. May 25 return? Yes. June 25 return? Yes. July 25 return? Yes. August 25 return? Yes. September 25 return? Yes. October 25 return? Yes. All these returns should be filed on or before. If at all I'm filing, correcting it in October 2025 return, but I'm filing after 30th of November, not possible. So this is the last return. October 25 is the last return in which I can correct it to be filed on or before 30th November. So last return is October 25. Main condition to be filed on or before 30th November. To be filed on or before 30th November. Can I correct it in November return? No. Why? My November return will be filed in 30th November is gone. 30th November is gone. So this is a time limit. Very, 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 very important time limit. And this is same time limit in all the three places. So once you are clear with it, you can apply the same thing even there. What are the three cases where time limit is the same? Rectification of returns. Last date for raising your credit note for sales return or discount. Credit note, decreasing the value, decreasing the tax. And last date for claiming input tax credit. Last date for claiming input tax credit. So what are the 7 conditions that we have discussed? What are the 7 conditions that we have discussed? Registered business, document, goods services, return, depreciation, time limit. Next is 180 days. You're talking about your 180 days. If at all I'm taking the credit, I'll be the recipient, you are the supplier. I have to make you the payment within 180 days. I have to make you the payment within 180 days. What payment? Entire payment. If I want the credit, I have to pay you the value plus tax within 180 days. So government is taking care of the supplier because supplier pays output tax from his pocket. And government is telling that recipient, you pay him soon because we have got the tax from him. But you please pay him soon. You please pay him soon. So I have to make the payment within 180 days. What if I don't pay within 180 days? Please understand, initially I'll take the credit whether or not I'm going to pay within 180 days. The moment I get your invoice and the moment I get your goods and services, I'll take the credit. If I pay within 180 days, nothing. If I don't pay within 180 days, I have to reverse the same to the extent of non-payment with interest, with interest, with interest. So first step is avail the credit. Second step is if I don't pay within 180 days, I have to reverse it with interest. Third, as and when I make the payment, can I re-avail the credit? Yes. But interest paid cannot be re-availed. So what are the three steps? Step number one, avail the ITC without waiting for 180 days. Second step, if I don't make the payment within 180 days, reverse the ITC with interest. Interest on input tax credit will be discussed in section 50. It's discussed in section 50. Third, I may make the payment to the supplier after 2 years, 3 years, correct? As and when finally I make the payment, I will re-avail the ITC. But wait, interest paid will be cost. I cannot re-avail. Interest paid will be cost. Step number one, the moment I receive the goods, receive the document, take the credit. Receive the goods services, receive the document, take credit. If I make the payment within 180 days, no issues. If I don't make the payment, reverse it with interest. As and when I remake the payment, finally I make the payment after 2 years or 3 years or 4 years, can I re-avail the credit? Yes, but I cannot re-avail the interest. Interest paid will be a cost. And please understand that there is no time limit for re-availment. Time limit is only for availment. There's no time limit for. So that time limit that we've discussed, 30th November of next financial year or actual date of annual return, that is only for availment. First time availment. It is not that for. So after 2-3 years, I am paying the entire amount to supplier. Can I avail the credit after re-avail the credit after 2-3 years? Yes, because it is not availment. It is re-availment. It is not availment. It is re-availment. There's no time limit for re-availment. There's no time limit for re-availment. Are you guys clear with this understanding? So this is condition number 8. Condition number 9. Condition number 9. If supplier has done fraud, recipient cannot take the credit of that tax. If supplier has committed fraud and tried to pass on the credit to the recipient. If supplier has committed fraud and tried to pass on the credit to the recipient. Who has done fraud? I have not done fraud as a recipient. You have done fraud. You have been asked to pay some payment of tax to the government. Now what are you trying to do? You're telling that, see, I have committed fraud. Taxes to be paid to the government with interest penalty. I will give you an invoice or debit note for the tax portion. So there's no loss for you. I'll pay the tax. You take the input tax credit. Net effect is 0. You pay me that credit amount because anyways you can enjoy the input tax credit. This can be happening with related party transaction or closed customers. Now it is said that no, I cannot avail ITC. Officer with great difficulty has found that supplier has committed some fraud. Correct? Instead of paying 18%, supplier was not paying anything. Purposefully. Officer found that you have to pay and he is giving you an order. Right? Now you are paying 18% tax plus interest plus penalty. Interest and penalty is always your cost. But what you are trying to do with your tax? You are trying to give me tax invoice or debit note for that 18% tax. Why? You tell that you please at least pay me that tax amount. Anyways, I can enjoy the credit. The government is very clear. This supplier has committed a fraud and he is now paying this 18% tax out of demand order. He is not paying willfully, he is paying forcefully. Now, if he pays output tax and I get credit and I pay him the tax amount, the entire work of officer is of no use. Officer with great difficulty has caught the supplier. Now it is said to me that no, this tax is paid by the supplier not willfully but forcefully. This output tax paid by the supplier is not willfully but forcefully. As a recipient, I may not be participant to the fraud. I may or may not be, but I cannot take the credit. Who is committing fraud? Be very clear. Supplier has committed fraud, paid the output tax forcefully. As a recipient, I cannot take the input tax. That fraud is defined in 3 sections. Section 74, Section 129, Section 130. Section 74, 129 and 130. We will be seeing it further. 74, 129 and 130. Right. So now, how many conditions we have seen? 9. What are the conditions? Registered, business, document, goods services, return, depreciation, time limit, 180 days, fraud. 180 days, fraud. 10th condition. I can take the input tax credit only if I get in my GSTR 2B. As a supplier, you're going to file GSTR 1 or IFF, correct? Italy or mini-Italy. Outward supplies. Italy or mini-Italy. Your outward supply is my inward supply. I'll get that in GSTR 2A and GSTR 2B. Actually, I'll get in GSTR 2A as well as GSTR 2B. But what is relevant for credit? What is relevant for credit? It's not GSTR 2A, it is GSTR. So what is the difference between 2A and 2B? I'll get the credit details of inward supply both in 2A and 2B. But what is the difference? 2A is dynamic. It keeps changing. 2B is static. 2B is static. 2A is dynamic. 2B is static. Supposing you are my two suppliers, supplier 1 and supplier 2. You have filed your IFF or GSTR 1 for the month of April. For the month of April. You have filed for the month of April on 10th of May and on 17th of May. 10th of May and 17th of May, which means within due date, after due date. Within due date, in GSTR 2A, it will be updated in April month's GSTR 2A. If I file in time, it will be updated in April month's GSTR 2A as well as April month's GSTR 2B. April month's GSTR 2A as well as April month's GSTR 2B. But second supplier was not filed on time. It will be appearing in April month's GSTR 2A again. When I download my 2A on 10th of May, I'll see only supplier 1 purchases. When I download my GSTR 2A on 17th or 18th of May, I'll see both supplier 1 and supplier 2. I'm talking about downloading April month's 2A. Downloading. But when I download my 2B, 2B can be downloaded only on 14th of next month. Why? What is the due date of 1? Normally 11th of next month. IFF 13. So few suppliers can be under 1 and few suppliers can be under IFF. When finally my GSTR, when finally my inward supplies will be finalized. Few suppliers will be in GSTR 1, MRMP scheme, few will be under QRMP scheme. IFF for the first 2 months and GSTR 1 for the third month, which means again 13th. So I have to wait till 13th of next month. Till 13th of. So my 2B will be finalized on 14th of next month. My April month 2B will be finalized on 14th of. Now understand whether I download my 2B on 14th of next month, that is 14th of May or 20th of May or June or July or August, after 2 years, after 5 years, my April month's GSTR 2B will contain only supplier 1 purchases. Supplier 1, it will not contain my supplier 2 purchases. Even if I download my GSTR 2B after 17th of May, I will not get supplier 2 data. I will not get supplier 2 data. It is static. On 14th of next month, it becomes freezed. Whatever has come will come. Whenever you download, you'll get the same data. Whenever you download, you'll get the. Whereas GSTR 2A, it keeps changing. Out of 2 suppliers, 1 supplier has filed on time. On 14th of May, if I download, I'll get only supplier 1 purchases. On 18th of May, if I download, I'll get supplier 1 purchase plus supplier 2 purchase. It keeps changing. It keeps changing. 2A will be helpful for your annual return, but not for ITC. For ITC, what is relevant? 2B. So then where will supplier 2 data come? Supplier 2 data will come. I can take the credit, but not in April. I can take the credit in. Why? It is after due date of April, but before due date of May. It is after due date of April, but before due date of May. Are you guys clear with this understanding? If I change this data Assuming that April month's GSTR1 or IFF, I have not filed on 17th of May. I have filed very late. I have filed very late on 21st of June. Then, any change in the answer? 2A, no change. 2A, whenever I download, it keeps updating. Finally, answer will be April only. But I have to download after 21st of June. Till 21st of June, when I download 2A of April, I'll get only supplier 1. On 22nd of June, if I download my April month's 2A, I'll get supplier 1 and supplier 2. But what about 2B? The moment after 14th May is gone, whenever I download April month's 2B, I'll get only supply 1 detail. Even if I download on 22nd of June, my GSTR 2B of April, I'll get only supplier 1. Where this supplier 2 data will go? June or July? Think and answer. After which due date, before which due date? After due date of May, but before due date of June. After due date of May, but before due date of June. So it will be reflected in not July. After due date of May, that is due date of May is 11th or 13th of June, correct? But before due date of, after due date of May, but before due date of June. June month's due date is 11th July or 13th July. So it is between that time. So it will be reflected in June months to be. I can take the credit in June month. For this supplier 2, I can take the credit in June month. I can take the credit in for supplier 1. When I can take the credit? For purchase from supplier 1. Both the purchases are made in the month of April. Both the purchases are made in the month of April, correct? For purchase from supplier 1, I can take the credit in which month? April 1. For purchase from supplier 2, which is made again in the month of April, which is again made in the month of April. But he has filed his GSTR1 or IFF very late. When can I take the credit? June month. With this example, understand the implication. ICA does ask these questions. Right? I have purchased both from supplier 1 and supplier 2 in the month of April. I have received the goods in the month of April. I have received the document in the month of April. I am technically eligible to take the credit in the month of April. But supplier 1 has filed his GSTR1 or IFF on time. For April month, it is on or before 11th of May or 13th of May. He has filed on time. I can take the credit in April itself, correct? Supplier 2 has not filed his GSTR1 or IFF on time. He has filed it very late. My 2A will keep updating. Forget about 2A because 2A is relevant for annual return, not for ITC. For ITC, 2B is relevant. When will I get that in 2B of which month? I'll get in 2B of Y. It is after due date of May, but before due date of June. After due date of 1 and IFF of May, but before due date of 1 and IFF of June. So when will I get that credit? June month's 2B. When I download June month 2B, I'll get it. April month 2B, I'll not get supplier 2. May month 2B, I'll not get supplier 2. When will I get? June month 2B. I can take the credit only in the month of June. Though I purchase in April, but I can take the credit only in the month of June. Are you guys clear with this understanding? So that is the significance of GSTR 2B. I can take the credit only if it appears in my GSTR 2B. My GSTR 2B. But there is an exception. What is that exception? That this 2B is not relevant for few cases. What are the few cases? RCM from unregistered supplier, import of goods, invoice from my head office, ISD invoice, or invoice of NRTP. I'm not talking about NRTP. I'm talking about I am purchasing from NRTP. We are not discussing about NRTP. We are discussing about a recipient purchasing from NRTP. A recipient who's purchasing from NRTP. So what is the significance? These 4 items, whether they appear in 2B or they don't appear in 2B, I can always take the credit in the same month. I need not worry about it. If I have RCM from unregistered supplier or import of goods, IGST credit, BCD, SWS, I cannot take the credit. Or head office invoice of ISD or NRTP invoice, purchase from NRTP. Whether I see it in my 2B or not, I can take the credit. In all these 4 cases, even if it is not appearing in my 2B, I can take the credit. They are all special cases. Other cases, only if it appears in my 2B, I will take the credit. These 4 cases, Even if it is not appearing in my 2B, even if it is not appearing in my 2B, I can take the credit. I can take the credit. Right. So this is the, I say doesn't touch this exception, but yes, that is the exception. These 4 cases, even if it is not appearing in my 2B, I can take the credit. So how many conditions we have seen? Rather, there was an exception even for this 180 days, which you missed out. Exception means normally for getting the credit, for retaining the credit, I have to make the payment within 180 days. This 180 days criteria is not relevant for RCM. For Schedule 1 supplies, free supplies, when there is no consideration, there cannot be any payment. When there is no consideration, there cannot be any payment. So this 180 days is not relevant for RCM. In RCM, I'll pay the credit, I'll pay RCM by cash ledger, I'll get the credit in credit ledger. Whether I'm making the payment to the supplier within 180 days is not at all relevant. It is not relevant for Schedule 1 supplies. Why? There is no consideration. When there is no consideration, there cannot be any payment. There cannot be any payment. It is also not relevant for recipient making the payment to third party on behalf of supplier. This we have seen in valuation chapter. This we have seen in. Now let me explain that same example again. Supposing you are the supplier, I am the recipient. Our contract is 10 lakhs. But you have asked me to pay 1 lakh to third party on your behalf. You asked me to make the payment. You have asked me to make the payment. So finally, how I make the payment? 1 lakh to third party and 9 lakhs to you. 1 lakh to third party and 9 lakhs to you. But GST will be on what? 10 lakhs. Why? Payment by recipient to supplier 9 lakh plus payment by recipient to third party on behalf of supplier 1 lakh. So GST will be on 10 lakhs. They are telling that 180 days criteria is relevant for GST on 9 lakhs. GST on 9 lakhs. It is not applicable for GST portion on 1 lakh. Why? It is already paid. It is already, I have already paid to the third party. This 180 days criteria is applicable. But for what? First of all, answer me this question. GST will be on 9 lakhs or 10 lakhs? Valuation chapter. 9 lakhs or 10 lakhs? 10 lakhs. This is 180 criteria. 180 days criteria is not at all applicable for this entire transaction. No. It is applicable, but for GST portion on 9 lakhs. GST portion calculated on, it is not applicable for, why 1 lakh is already paid. So there's no need to worry about it. Actually, you need not even see this. By default itself, even if you try to apply it, 1 lakh is already paid. Pro rata basis will calculate. Supposing I have to pay supplier 10 lakhs, I have paid 5 lakhs within 180 days. What will happen? Will I reverse the entire credit or I will reverse the credit only proportionately to the extent of 5 lakhs? Pro rata basis. GST on 10 lakhs will be 1,80,000. So I paid 50%, 5 lakh plus 90,000. I'll reverse the credit of what? GST invoice value was 10 lakh plus 1,80,000. 11,80,000. 1,80,000 is GST. I paid you 5,90,000 within 180 days. 5,90,000 within 180 days. Will I reverse entire 1,80,000 credit? No. I'll reverse only 90,000. So the balance 5,90,000 multiplied by 18 divided by 118 will give me 90,000. I'll reverse only 90,000 proportionately. Same way you could have applied it. Same way you could have applied it. So, how many conditions we have seen? 10. What are they? Registered, business, document, goods services, return, depreciation, time limit, 180 days, 2B. 180 days, fraud, 2B. 180 days, fraud, 2B. There is actually a 11th condition, which is a time bomb, which is not applicable as of now because rules are not yet notified. Actually, there's a condition, but very happy that it is not yet notified and it has come long back. But even government till now has not notified the rules because it is very dangerous provision. Even after getting in 2B, I should check a lot of things. Getting in 2B is not sufficient. Even if I get, I should see whether the supplier is good supplier or bad supplier. After getting in 2B, I should evaluate supplier is a good supplier or it's not applicable. So let us forget about it. Now, the last condition, 11th condition. The last condition, which is the 11th condition, is supplier should pay the tax. Supplier should pay the tax. So only if supplier is paying the tax, only and only if supplier is paying the tax, I can take the credit. Now, previous condition was based on supplier filing, GSTR 1 or IFF, so that I get in GSTR 2B. So previous condition was also based on supplier, but supplier filing 1 or IFF. Now it is supplier should pay the tax. Supplier should pay the tax, but there is a difference. And 10th condition and 11th condition we are trying to differentiate. In the previous point, if supplier files 1 or IFF, I will get that information in, and based on that I'll take the credit. Based on that I'll get the credit. But whether supplier has paid the tax or not, I will never get that information. As a recipient, actually, practically, I'll never get that information. Officer has to inform me. And here, this condition is actually for availment of ITC, which means only if I get the credit in my GSTR 2B, I can take the credit. But here, it is not about availment of credit. You can avail it. Initially, without seeing whether supplier has paid the tax or not, you can avail it. But if he has not paid the tax, on or before 30th November of next financial year, on or before 30th, no annual return here, on or before 30th of November of next financial year, then first I will avail the credit. Without seeing whether he has paid a tax or not. Step number 1. But in the previous condition, only if I get into B, I'll take the credit. If I'm not getting into B, I'll not take the credit. Second, if the supplier has not paid the tax, on or before 30th November of next financial year, I have to reverse the credit with interest. This information who will give me? Only officer has to give me. I cannot actually find it out. And as and when he finally makes the payment of tax to the government, can I re-avail the credit? Yes, I can re-avail the credit, but I cannot re-avail the interest. Initially, I will avail the ITC. If supplier did not pay the tax to the government on or before 30th November of next financial year, I'll reverse it with interest, and interest in this case will be calculated from 1st December of next financial year. Interest will start from 1st December of next financial year. And finally, when supplier finally makes the payment of tax, this information will be given by supplier to me that, see, because of me you have reversed with interest, government and officer gave me notice, I have paid the tax. If you have reversed it, now please re-avail the credit. So I'll re-avail the ITC, but interest will be a cost. Now there's a clear-cut difference between these two conditions. Both of them, there's a common point in both. Both of them are dependent on supply doing something. One, I can see it real time, I will decide real time. If supplier files this outward supply in GSTR 1 IFF, I'll get in my 2B. Based on that, I'll take the credit. Right. Second, it's a real time. It's all about availment. No reversal, no re-availment. It's all about availment. Second, if supplier is paying the output tax, I will not know. So initially, whether supplier has paid output tax or not, I will take the credit. But if someone informs me, officer informs me that he has not paid output tax till 30th November of next financial year, I have to reverse with interest from 1st December of next financial year. As and when I get the information that supplier has finally paid the output tax, what I will do? I will re-avail the credit. Re-availment, no time limit. Point number 1, re-availment, no time limit. Point number 2, I cannot re-avail interest portion. These points are the 11th condition. Now, you have to understand out of these 11 conditions, totally how many conditions are there now? Out of these 11 conditions, 9 conditions and 2 conditions, split it. 9 conditions and 2 conditions. Out of that, split that into 8 condition and one condition. These two conditions, what are the two conditions we are talking about? These two conditions we are talking about: recipient not making the payment to the supplier of price plus GST within 180 days, and supplier not paying the output tax GST portion, not paying the output tax on or before 30th November of next financial year. Please do understand, these two conditions are basically talking about first availment of ITC without checking them, then reversal of ITC with interest, and finally when you satisfy it, it is re-availment of ITC, but interest portion will not be there, which means these two conditions are not checked real time. They are not checked. First you take the credit, you don't wait for 180 days, but both are very different. Please understand, the first part is recipient making the payment to the supplier. What? Both, entire value plus GST within 180 days. Second one is supplier making the payment to the government. What? Only the output tax GST portion within 30th November of next financial year. You will not wait real time. You will not wait real time. You will take the credit. Then you will check whether you have done it or not. If you have done, no worries. If you have not done, reverse with interest. Finally, when you do it, re-avail the credit, but no re-availment of interest. All the other 9 conditions, only when you satisfy it, you will get the credit. If you don't satisfy it, you will not even get the credit. These 2 conditions, you will not see real time. You will see afterwards. But all the other 9 conditions, you have to satisfy. Then and that, you have to satisfy. If you don't satisfy, you will not get the credit. Forget about reversal and re-availment and all. If you don't satisfy, no credit. If I have not received the goods, no credit. If I have not received the document, no credit. If I have not received in GST 2B, no credit. Is the difference clear? These 9 conditions, only if I satisfy, I will get the credit. Other 2 conditions, I am not going to check now. I am going to check later. I am going to check later. So in this 9 conditions, you have written it as 8 plus 1. So what is this 1? This 1 condition is you getting that in GSTR 2B. Why is it so, sir? Because in all these 3 cases, it is applicable only for FCM case. It is not applicable for RCM case. But in all these 8 conditions, balance 8 conditions, it is applicable for FCM as well as RCM. Rather than biatting differently, life is very simple if you have a clarity of chart. There are totally 11 conditions. 9, check it real time. Only if you satisfy, take the credit. 2, don't check it real time. Later. You take the credit now, you check it later. You check it later. Out of 11 conditions, 8 conditions are applicable for both FCM cases and RCM cases. But these 3 conditions, 2B, 180 days and payment of tax by supplier, they are applicable only for FCM cases. They are not applicable for RCM cases. They are not applicable for RCM cases. Are you guys clear with this understanding? Once you satisfy all these conditions, once you satisfy all these 11 conditions, you will take the credit. You will take the credit. And when you are taking the credit, you will take the credit of everything. If it is intra-state supply, you will take the credit of CGST, SGST and compensation cess. If it is interstate supply, IGST and compensation cess. If it is import, you will not take the credit of BCDs, SWS and special import duties. You can take the credit only of IGST and compensation cess. Once you avail the credit, you will use the credit. What is the formula for utilization? We have discussed it already. What is the formula for utilization? Remember your elder brother? Don't look at me. Right? Remember? Okay, you can look at me also. I have married now for almost 10 years. 10 years is going to complete. So you can think of me as your elder brother who's married for almost 10 years. Then mom and wife. So first Your elder brother is IGST. Then my mom is CGST. My wife is SGST. So first who will contribute? IGST credit. First for myself, IGST output. Then for, I'll not take the risk. Balance portion. CGST credit, SGST credit, any ratio. That is the point where you have to intellectually apply and see trial and error basis, which is the best portion. Which is the best portion. Otherwise, it is a straight cut sequence. Second, if once IGST credit becomes 0, then you will touch CGST credit. First for CGST output. Next for IGST output. But never for SGST output. Last, SGST credit. Last portion. The Y portion will come. Last SGST credit. First for SGST output. Undoubtedly. Balance IGST output for our husband. If there is any other balance, SGST credit will never be used for CGST output. CGST output. Clear? Clear? Now, if you get the highest complicated question, which ICA is asked, how to work out? Step number 1. Make things very clear. Step number 1, it should be calculating gross output tax. Very basic question. They will give you interstate supply, intrastate supply, calculate CGST, SGST, IGST. Right. Second, they'll be giving certain expenses which attracts RCM. Calculate RCM. And please do not work like ICA in the same table. Work separate table. Output, gross output tax, separate table. RCM, separate table. Third, input tax credit including RCM input tax credit. Input tax credit including RCM input tax credit. And that is the reason first work out RCM. First work out RCM. Because RCM, what you'll do? You pay by one hand and you get the credit in. You pay by cash one hand, you get the credit in other hand. You pay by cash one hand, you get the credit in other hand. So please be very clear, careful with the sequence. Lastly, we are talking about final payment by cash. Final payment by cash. In this final payment by cash, split into two. One is RCM that you are going to pay by cash. Correct? Because RCM, what is the first one thing that you know about RCM? Pay by cash, get in credit. So we have already taken in credit because that is the step you have to follow practically. But you have to pay by cash, right? So you would have paid by cash. So RCM will be paid by cash. Then net output tax paid by cash. Net output tax paid by cash. So how you will calculate net output tax? Gross output tax from step number 1 less input tax credit from step number 3. Input tax credit from step number 3. This RCM has come from step number 2. You'll get net output tax. You'll get net output tax. So you'll have this figure and you'll have this figure. If you total that, you will get total payment by cash ledger. Total payment by cash ledger. These two portions. What are the two portions? If I want to write RCM portion and net output tax payable portion. Wait, don't stop your answer here. Always when you conclude your answer, write ITC carried forward. Though that will never be asked in the question, write it. Is there any ITC carried forward? Because that is the way where you will see trial and error whether you have calculated this ITC utilization correctly or not. This is the indication that whether you have utilized the ITC correctly or not. So always write ITC carried forward. Question will never ask. We always write ITC carried forward. This is the master question data, the highest complicated question which can come, and this has to be presented in this way. If you present in this way, you will not make any silly mistakes. And one important point I forgot to tell you, that please always go with ICS. Never go with CSI. Always write in IGST, CGST, SGST. IGST, CGST, SGST. Are you guys clear with this understanding? Are you guys clear with this understanding? Where is the area where you have to be very cautious with the utilization portion? IGST credit first used for IGST output. Balance portion used for CGST output, SGST output. Any ratio? Normally, you think that will split equally. Correct? At times, you should not split equally. At times, you should split in such a way that final cash payment is less. I'm not going to work out and all. Just think this area. This is the only area. This is the only area where you have to go by trial and error basis. Normally, what you'll do, supposing you have IGST credit of 10 lakhs and you have IGST output of 4 lakhs. You'll use it first. Balance. Don't split always by 3 lakhs, 3 lakhs. In normal question, you can split it equally. But if the credit is in such a way that credit is more of SGST and less of CGST, in the second and third step, it is not matching. You have to balance in such a way that you give the minimum answer by cash. You should not spend more by cash. So here you have to do trial and error basis. Trial and error basis. Are you guys clear with this understanding? And that is the reason I'm asking you to finally write. And that is the reason I'm asking you to finally write ITC carry forward. So that if you compare payment by cash and ITC carry forward, you'll end up that I have so much credit, but still I have paid by cash. Have I done something wrong? It is possible that you have credit, but you have paid by cash. But just check, have I done anything wrong? And this anything wrong will be possible only in which area? IGST credit used for CGST output, SGST output in any ratio, any other thing, you cannot do anything. All other things are freezed. Whether you like it or not, you have to go by that sequence. Whether you like it or not, you have to go by that particular sequence. And one important point in that chart I have forgot, when you are writing less ITC, please don't write in one line. Never write in one line. Less ITC should be there in 3 lines. First, IGST ITCs. Next, CGST ITC. Next, see your output tax will be in one line. But ITC utilization, write in. Why? First, you are going to use IGST credit. Properly, you have to match. So you have above IGST, CGST, SGST in columns, and here in rows you have IGST credit, CGST credit, SGST credit. Properly think and answer. So please, this is again one important change that I'm doing. I should have written there itself. When I'm doing less ITC, don't write in one line. Never do this ICA stunt where they will set off in one line and write explanation. It will not make sense. Write in 3 lines. IGST credit, utilization, then less ITC, write in 3 lines. IGST credit, then CGST credit, then because that is the sequence. IGST credit, CGST credit, then SGST credit. Then use in that formula. The only area where you have to apply your mind. Other area don't apply your mind. I am not telling that if I have extra credit balance, I should not pay by cash. There can be situation where I have credit balance, but still I end up paying by possible. But if at all there is a situation where IGST credit is there, used for IGST output and balance to be used for CGST and SGST output in any ratio, in any proportion, you could have balance in such a way that your cash payment is minimum. Cash payment is minimum. So there you have to be very cautious. This is the master summary chart, the complicated question, and you'll finally have answers in how many tables? 4. Gross output tax, 1 table. Second, RCM, 2nd table. Third, ITC including. ITC will include the RCM portion. 3rd table. Fourth is payment by cash. Payment by cash split into 2. RCM you have to pay by cash. You have taken the credit, but first you have to pay by cash. That area. Then net output tax. Net output tax is gross output tax taken from first table. This RCM is taken from second table. Gross output tax taken from first table. Less ITC taken from third table, which includes RCM ITC. Net output tax. When you are doing less ITC, proper sequence, 3 lines. IGST ITC, CGST ITC, SGST ITC. Then pay total payment by cash. Don't forget that. Total payment by cash is RCM portion plus net output tax payable portion. And always write ITC carry forward. What will be the ITC carry forward? ITC carry forward, how you will find it? Your ITC carry forward, you will find it from what was the available ITC, how much you have used. This will be the balance ITC carry forward. Balance ITC carry forward. So that short question you will get. Utilization is a short question. Short question. Obviously, when ICA gives a question, ICA makes the question very simple. ICA gives only this area. Only this area. Generally. Gross output tax, less ITC, net output tax, payment by cash. Payment by cash, RCM itself is not there. It's only net output tax payable and ITC carry forward. So ICA focuses only on this area. But if it is a question which involves all these aspects, yes, there are questions which involve all these aspects. If ICA increases the number of marks, say from 4-5 marks to 8 marks, then it might give all these datas and ask you to work out all the steps. Don't work out in one table. Have it differently. Even it is easy for the evaluator. Secondly, you don't end up making silly mistakes. This is a standard table that you should have. Right? So that is everything about your ITC availment and ITC utilization. Availment and your utilization. Now when you talk about your blocked ITC, first area is all about your motor vehicles, aircraft and vessel. Motor vehicles, aircraft and vessel. Now please understand that when you talk about the motor vehicles, aircrafts and vessels. Motor vehicles, aircrafts and vessels. Split motor vehicles and aircrafts and vessels first. Motor vehicles split into 3 parts. Motor vehicles, you call it as special motor vehicles. Motor vehicles used for goods, motor vehicles used for passengers. Special motor vehicles are such motor vehicles like your dumpers, tippers, tractors. They are not used for transportation of goods or transportation of passengers. Special motor vehicles will always have full credit. Goods motor vehicle will always have full credit. Even in passenger motor vehicle, if you're talking about a scenario where it is having seating capacity more than or equal to 14. More than or equal to 14. If it is less than or equal to 13, no credit. If it is more than or equal to 14, will you take the credit? You're talking about bus or minibus where the seating capacity is 14 or more than 14. 14 or more than 14. You can take the credit. If the seating capacity is 13 or less than 13, 13 including driver, 13 or less than 13, you cannot take the credit. You cannot take the credit. But there are 3 exceptions. When I tell exception, what it means? Exception means you can take the credit. What are the 3 cases where you can take the credit? First, transportation services, transportation of passenger services. Second, you are talking about driving schools. Third, you are talking about further supply. In all these 3 sectors, transportation of passenger sector or driving school or further supply means purchasing and selling. Without motor vehicle, you cannot do business. Without motor vehicles, you cannot do business. Can you tell a dealer of a 2-wheeler telling that you cannot take the credit? He will tell that this is my main item, stock. Can you tell Chamundi driving school not to take the credit? He will tell that this car is the main item for my business, take the credit. Can you tell Red Taxi not to take the credit? Red Taxi company will tell this is my main business. How can you tell me not to take the credit? So what are the 3 sectors where motor vehicle is must? Even if the motor vehicle is less than or equal to 13 passengers, it is must for doing the business. It is must for doing the business. What are they? So accommodation of passengers, driving schools and further supply. Further supply means selling that, purchasing and selling that motor vehicle or renting that motor vehicle. Further supply. Further supply. What about aircrafts and vessels? Aircraft and vessels directly starts with not taking the credit. Directly they tell that first itself they tell no taking the credit. Then they give exception. Now can Indigo take the credit? Indigo Airlines? Yes. Transportation of passengers. Transportation of passengers. It can take the credit. Right. So then in what case aircrafts and vessels will not get the credit? I'll give you an example. Reliance Limited purchasing an aeroplane for transportation of its managing director Mukesh Ambani for business purposes. Be it business purposes, but no credit. Why? Is it covered by transportation of passenger? No. Is it covered by your driving school? No. Is it covered by further supply? No. No credit. Rajmouli, the director cum producer, is purchasing a helicopter for transportation of its crew members to a distant area of shooting location. Can the production house of Rajmouli take the credit? No. It is not covered in transportation of passenger, driving school and further supply. Kingfisher Limited purchases a cruise for its business purposes. Can it take the credit? No. It is not covered in transportation of passenger, driving school or further supply. Are you guys clear with this understanding? Right. Now, we are talking about purchase of these motor vehicles, aircrafts and vessels. What about the related services? Related services. Are you guys clear with this understanding of motor vehicle, aircrafts and vessel? Now, the next part is pretty simple. I have the first category of motor vehicle or aircraft or vessel. Second category of motor vehicle, aircraft or vessel. First category is eligible and second category is ineligible. The first category, if it is eligible, I can enjoy everything. Second category, if it is ineligible, I will not get any credit. So if at all first category is eligible, it means, supposing I am talking about auto for transportation of goods, not passengers. A company is purchasing a auto for transportation of goods. Can it take the credit? Yes, it is very much clear. Right, it is eligible. And second category, supposing I am talking about company purchasing a car for its managing director or for its employees. No credit. No credit. Now, in the first category, whether I purchase it or take it on rent or lease or hiring, or I have general insurance service on it, or I have repair and maintenance service on it. These are all things possible. See, whenever I purchase any motor vehicle, aircraft or vessel, I do have two options. First, purchase option or renting option. So if at all at the time of purchase it is not eligible, even at the time of renting it is not eligible. Now whether I purchase a vehicle or rent a vehicle, there will be general insurance service, there will be repair and maintenance service. I'm sorry, it is eligible. There will be renting, there will be general insurance service, there will be repair and maintenance service. So when an item is eligible, whether I purchase it, take the credit, whether I take it on rent, take the credit, whether I have general insurance service on that particular motor vehicle, vessel or aircraft, take the credit, whether I have repair and maintenance service on that motor vehicle, aircraft or vessel, take the credit. If it is eligible, I will enjoy all the credits. I will enjoy all the credits. What if it is not eligible? What if I purchase a car for my company only for business purposes? Let it be for business purposes, but I cannot take the credit. Let it be for 100% business purposes, but I cannot take the credit. What will be the answer? If I purchase it, no credit. What if I take it on renting, leasing or hiring? No credit. What if I have general insurance service on that car? No credit. What if I have repair and maintenance service on that car? So if it is not eligible, whatever expenses I have on that, no credit. No credit. I'll make it very simple. Reliance Limited has purchased two motor vehicles. One, a bus for transportation of employees. Second, a car for transportation of its managing director. Bus is eligible. Why? Both are passenger transportation. Bus is eligible because more than or equal to 14. Can it take the credit on the bus? Yes. Whether it purchases the bus or takes the bus on rent, it can take the credit. Whether you have general insurance service on that bus or repair and maintenance service on that bus, you can take the credit. What about car? Whether you purchase that car, no credit. Whether you take that car on renting, no credit. You're taking the car on renting for business travels, no credit. Or you have general insurance service on that car, no credit. Or you have repair and maintenance service on that car, no credit. No credit. Are you guys clear with this understanding? Are you guys clear with this understanding? But there are certain exceptions for no credit. When there is credit, no exception. When there is no credit, there are certain exceptions. Certain exception means you will get the credit. What is the exception? If it is because of statutory obligation. Statutory obligation. I'll give a practical example. You are having a company in Tamil Nadu, you are having a company in Delhi. Now, in both the places, I am purchasing car for my employees, for transportation of my employees. Can I take the credit? I am purchasing 10 cars for my transportation of employees. Can I take the credit? For purchase, there is no exception. I cannot take the credit in Tamil Nadu, I cannot take the credit in Delhi. But I am taking 10 cars on renting. 10 cars on renting for transportation of my employees. In Tamil Nadu, still I cannot take the credit, whether it is purchase or renting. But in Delhi, if I take the 10 cars on renting for night transportation of my employees, mainly women employees, I can take the credit. Why? In Delhi, a company is under statutory obligation to provide night transportation of its employees, mainly female employees. So now I am taking those 10 cars on renting or hiring or leasing because of, but look at the difference. Tamil Nadu, there's no such statutory obligation. Delhi, there's a statutory obligation. But it does not change the answer for purchase. If I purchase 10 cars, no credit in Tamil Nadu, no credit in Delhi. But if I take the 10 cars on renting, no credit in Tamil Nadu even now. Credit in Delhi, only for renting, hiring and leasing. So this exception is not for purchase. This exception is only for renting, hiring or leasing. Statutory obligation. Statutory obligation. Clear? Clear? Next, the exception is for both general insurance service and repair and maintenance service for two sectors. One, manufacturer of motor vehicle. Second, general insurance company. I'll give example for both. Manufacturer of motor vehicle. Tata Limited is manufacturing nano cars. Tata Limited is manufacturing. Think of this, whether Tata Limited will purchase the car and sell the car or purchase the raw materials, manufacture it and sell it. Correct? Correct? So Tata Limited will never have any question of purchase of cars. It will purchase the raw material. On the raw materials, will it take the credit? On the raw materials, will it take the credit? Correct? Now, it is having car. Car is seating capacity is less than or equal to 13. Though it may be ineligible category, but don't you think that if Tata Limited has manufactured 1 lakh cars, it will take general insurance service on that cars? Correct? Should credit be allowed? Yes, we are not talking about trader, we are talking about how can you not allow the credit to him? Main business. Tata Limited on that 1 lakh car will have some small repair and maintenance. Will credit be allowed? Yes, main business. See, the answer is separate for a normal businessman. But for a manufacturer of motor vehicle, even if he's manufacturing small cars less than or equal to 13 seating capacity, for him, general insurance services very important for the business. Repair and maintenance services very important for the business. Take the credit. Take the credit. And by the way, Tata Limited will never have this discussion about purchase and all. Why? These cars, 1 lakh cars, they are neither purchased nor taken on renting, leasing, hiring. They are manufactured. See, for other companies, they do purchase or they do take on hire. Then there is general insurance service, repair and maintenance service. For Tata Limited or manufacturer motor vehicle, there is no purchase, there is no renting, leasing, hiring. Those 1 lakh cars have been manufactured. First thing. Second exception, general insurance company. Now this exception is going to be very useful for all the other points. So look at this particular point very carefully. Now, supposing there is general insurance company 1 and general insurance company 2 and there is Reliance Limited. Now, Reliance Limited has purchased, there's an aeroplane purchased by Reliance Limited for its managing director. for its managing director. And Reliance Limited is taking insurance on this aeroplane. Taking insurance on this. What is the service? General insurance service on this aeroplane. Now, general insurance company will pay output tax. Reliance Limited, can it take ITC? No. Why? Airplane is ineligible item. Whether you purchase or take it on renting, hiring, whether you have general insurance service or repair and maintenance service, you cannot take the credit. Because Reliance Limited is not engaged in transportation of passengers, driving schools, or further supply. It cannot take the credit. Therefore, it cannot take the credit even on general insurance service. This general insurance company thinks that the risk factor of insurance on this aeroplane is very high. So it will go for reinsurance. It will go for reinsurance. Reinsurance with another insurance company. Now that another insurance company will pay output tax. Can this general insurance company take input tax credit? Again, understand that this general insurance service is also against the same aeroplane. But can this general insurance company take the credit? Yes. Reliance Limited cannot take the credit, but the general insurance company can take the credit. Please understand that in technical language, it is called as, first contract is called as main contract, second contract is called as subcontract, second contract is called as, and please understand that when it is subcontract, always credit is eligible because it is integral part of business. Integral part of, see, in the first scenario, you're looking from the eyes of Reliance Limited. In the first scenario, you're looking from the eyes of Reliance Limited, yes, you cannot take the credit. Main contract. In the second case, you're looking from the eyes of general insurance company 1. Subcontract. Subcontract is there in every business sector. If I'm not able to do something on my own, I'll subcontract the work. Subcontract is essential part of business. Now, when I'm subcontracting, you cannot tell that this general insurance service is also taken for aeroplane, which is not eligible. Therefore, you cannot take the credit. This is true for Reliance Limited. This is true for Reliance Limited, not for general insurance company. I'll give another example so that it will be useful for the next points. Actually, we are done with your motor vehicles, aircraft and vessel. We are talking about other points. In the subsequent points, we will see that food beverages, outdoor catering is not eligible. Food beverages, outdoor catering is not eligible. There is an outdoor caterer 1 and there is an outdoor caterer 2. Reliance Limited is having an AGM. Reliance Limited is having an AGM where thousands of people are going to come and there is going to be outdoor catering service. Outdoor catering service. Outdoor caterer 1 will pay output tax because outdoor caterer 1 is having contract with Reliance Limited. Reliance Limited, can it take ITC? No. Why? Why? Outdoor catering services not eligible. Not eligible. Blocked. Now, outdoor caterer 1 took the contract that I'll provide the outdoor catering service for 5,000 people. But outdoor caterer 1 tells that no, I cannot do it on my own. I will take the help of another caterer. So he takes the help of another caterer. He will be having separate contract with another caterer. Supposing he is charging 1 crore from Reliance Limited, he may pay 30 lakhs to outdoor caterer 2, subcontract. But for subcontract, who's the supplier? Who's the supplier? Outdoor caterer 2. Outdoor caterer 2 becomes the supplier. He is going to collect 30 lakhs. He is going to collect, supposing outdoor caterer 1 is going to collect 1 crore, out of which he is going to pay 30 lakhs to outdoor caterer 2. Who's the supplier? Outdoor caterer 2 is the supplier. He will pay output tax. Can outdoor caterer 1 take input tax credit? Yes. Because here you are talking about for Reliance Limited main contract, no credit. But for outdoor caterer 1, it is the subcontract. Very important for any business. Very important for any business. Take credit. Take credit. Whenever there is a block credit, always there will be an exception. What will be that exception? Subcontract. If it is subcontract, can you take the credit? Yes. But you have to understand why it is allowed. Main contract, the restriction is on Reliance Limited. The main recipient cannot take the credit for the first contract. But for the second contract, who's the supplier? outdoor caterer 2. Who's the recipient? It is not Reliance Limited, it is outdoor caterer 1. Can he take the credit? Yes. Subcontract, he can take the credit. Subcontract, he can take the credit. So first part, we have discussed everything about your motor vehicles, vessels and aircrafts. Everything. All the points about your motor vehicles, vessels and aircrafts. Second part, we are talking about individual consumption. There are certain lists. There is a certain list. What is the first list? Food and beverages, outdoor catering, beauty treatment, cosmetic and plastic surgery, health services, life and health insurance. Life and health insurance. Food, beverages, outdoor catering, beauty treatment, cosmetic and plastic surgery, health services, life and health insurance. If these items comes in your question, even if all the conditions are satisfied, what is the significance of block credit? Even if all the conditions are satisfied, credit is 0. Even if you satisfy all the conditions, the moment you see this item, please don't waste your time evaluating conditions. Don't waste your time evaluating conditions. Credit is 0. Membership of a club or health and fitness center. Travel benefits to employees, but on what? For leave travel or home travel concession. If travel benefits are given to employees at the time of business travel, you can take the credit. Travel benefits to employees on vacation, on leave travel concession or home travel concession. Right. So 6 plus 2. 6 plus, you have these 6 points and these 2 points. Please understand, generally there is no credit. Generally there is no credit. Exception. Exception are 2S. Subcontract, statutory obligation. And both the Yes we already discussed. When it is subcontract, whether you will get the credit. When it is subcontract, whether you will get the credit. Yes. You discussed with outdoor catering. Subcontract, you will get the credit. Subcontract, you will always get the main contract, recipient will not get the credit. Subcontract, recipient will get the credit. If it is due to statutory obligation, will you get the credit? Yes. If you are not doing by choice, you are doing by force, because there is a law in India. Supposing there is a factory. In factory, you have to provide food to the laborers. So that is food and beverages. Whether that factory can take the credit, whether that company can take the credit. Yes. Why? It is not by choice. It is by force. Statutory obligation. We can remember this example for statutory obligation. Normally, food and beverages, no credit. But if there is a factory, there's a company having a factory providing food to its laborers. Can it take the credit? Yes. Statutory obligation. Statutory. And understand that. Then why have we distinguished 6 plus 2 points? For all these 8 points, statutory obligation is the common. Statutory obligation is the common exception. But subcontract is there only for first 6 points. Because in the last 2 points, that cannot be subcontract. Need not buy at it. For membership of a club, health or fitness center, or travel benefits to employees on vacation, home travel concession, leave travel concession, there cannot be a concept of therefore not given. See, there are 2 ways to remember it. One, buy at it. So first 6 points, 2 exceptions. Subcontract, statutory obligation. Last 2 points, only 1 exception, statutory obligation. Because for these last 2 points, you cannot have subcontract. Therefore, that is not there. Now, next category. First category, motor vehicles, aircrafts, vessels. Second category, employees related, personal consumption related. Next category, we are talking about works contract or construction. Works contract or construction. Now, please understand it this way. I can have goods and services plus construction service for a building, or I can directly go for works contract service, correct? So, if I want to make this building ready, either I can purchase cement, sand, bricks separately, then construction service. Or I can tell the contractor that you do everything. You do everything. Works contract. You do everything. Works contract. Works contract includes goods plus services, but it is a service. Works contract, service. We have seen that in schedule 2. Schedule 2. Now, if it is for, if the same is for civil structure or pipelines outside this factory or telecommunication towers. Civil structure, pipelines outside the factory or telecommunication tower, or if the same is for plant and machinery. The common point in both the cases is immovable property. We are not talking about plant and machinery which is movable, we are talking about plant and machinery which is immovable. If it is movable, you can always take the credit. Right. So what are the two categories now? Civil structure means building, godowns, factories, civil structure. Pipelines outside the factory. This will be there for petrochemical companies. This will be there for petrochemical companies. Telecommunication towers. For Jio, Airtel, VI, telecommunication towers will be there. Now, look at the government. This will show you the real picture of the government. Now, government tells that when you talk about civil structure, pipelines outside the factory or telecommunication towers, if the same is being capitalized, if the same is being capitalized to balance sheet, or if the same is charged to P&L. So, capitalized in balance sheet or charged to profit and loss account. If it is capitalized, the amount is huge. The amount is huge. When the amount is huge, government tells will not give you credit. If I am constructing a factory, government tells that I will not get the credit. Obviously, factory is going to be used for manufacturing purposes, connection with my business. But government tells I will not give you the credit. But once factory is ready, there are small repair and maintenance, painting, small repair and maintenance. Government tells now take the credit. Now take the, it is like teasing the assessee. Big credit, no, I will not give. Small credits, enjoy. Small credits, enjoy. You're getting that point? Big credit, not allowed. Small credits, enjoy. Can they tell this for plant and machinery? No. Government understands if they tell for plant and machinery, the entire business sector will revolt against the government. So plant and machinery, they tell whether it is capitalized or whether it is to taken to P&L account. You can always take the credit. You can always take the credit. For whom there's a difficulty? When you're talking about civil structure, pipelines outside the factory, telecommunication towers. This difficulty is not only for a businessman constructing a factory or a godown or a hotel, or say even ICA constructing this premises, or Jio company, telecommunication towers, or Reliance Petrochemical company, pipelines outside the factory. If they're capitalizing it, when they'll capitalize? New construction or major repairs, renovation, correct? New construction or major repairs, renovations, additions, alterations. So capitalization is not only at the time of new construction, it can be there at the time of major repairs, major renovation, major additions, major alterations. It is going to be capitalized. When it is going to be capitalized, you will not get the credit. When it is ready, when there are small repair and maintenance which are charged to P&L account, you will enjoy the credit. What if it is plant and machinery? Be it capitalized or taken to P&L account, you will always get the credit. But there is an exception when you don't get the credit. What is that exception when you don't get the credit? Exception means you will take the credit. And by the way, you need not break your head. Exception is simple. Subcontract. I am the builder constructing factory for Reliance Limited. Can Reliance Limited take the credit? I am the builder constructing factory for Reliance Limited. Can Reliance Limited take the credit? No. I am not able to construct that entire factory. I give it part of the work to another builder. Now builder 2 is paying output tax. Can I take the credit of that output tax? Yes. Subcontract. It is subcontract. Subcontract is always allowed. Subcontract is always allowed. Are you guys clear with this understanding? Right. What are the three parts in which we have divided the block credit? Motor vehicles, aircraft vessels, personal items for employees, immovable property. Immovable property, others. Now others are basically very simple. In others, already we have seen 3 points, and 3 points we have yet to see. We have already seen if it is composition tax, can you take the credit? If supplier is a composition scheme dealer and he's paying composition tax, can he take the credit? Already seen. If the goods are used for personal consumption, can I take the credit? Business condition is not satisfied. Business condition is, I cannot take the credit. Or tax is paid by the supplier because of fraud. Tax is paid by the supplier because of fraud. And fraud definition is section 74, 129, 130. If supplier is doing fraud and paying tax under 74, 129, 130, can recipient take the credit? Already these 3 points have been seen. Already we have seen these 3 points. Correct? If supplier is paying composition tax, I cannot take the credit. If I am using the goods or services for personal use, I cannot take the credit. If supplier is doing fraud and paying the tax under 74, 129, 130, recipient, I cannot take the credit. Now, what are the other points that we have to see? Other 3 points. Other 3 points. If the goods are used, if the goods are lost or stolen or destroyed or written off or given as gifts or free samples. Gifts or free samples. I would have taken the credit, but now I have to reverse it. I would have taken the credit, but now I have to reverse it. But when it is gifts or free samples, there are 2 answers. If I reverse the credit, no need to pay output tax. If I am purchasing something and giving it as gifts and free samples, if I have taken the credit and reverse it, net effect credit is 0. It is not deemed supply. It is not deemed supply. If I am having the credit, if I am reversing the credit, output tax will not be there. If I am having the credit, should I pay output tax? Yes, deemed supply. Deemed supply. See, for lost, stolen, I have taken the credit, reverse it. Destroyed, I have taken the credit, reverse it. Written off, I have taken the credit, reverse it. But gifts and free samples, there are 2 answers. If I reverse the credit, no need to pay output tax. No need to pay. On my purchase, I took the credit, but I reverse it. No need to pay output tax and I am giving it as gifts or free samples. If I am not reversing the credit, I took the credit at the time of purchase. For me to give gifts or free samples, first I should have purchased it. So I have taken the credit but not reversed it. If I have not reversed it, then it is nothing but deemed supply. Para 1, schedule 1. Permanent transfer or disposal of business assets on which ITC is awaited. On which ITC is awaited. Clear? This is only for the last point. Other points, when I put a cross mark, it means I have to reverse it. I have already awaited it, now I have to reverse it. Now, second case, if at all you are talking about non-resident taxable person, you cannot take any credit except, there is an exception. There is an exception. Exception means you can take the credit except IGST portion on import of goods. IGST portion on import of goods. If you are NRTP, which means recipient is an NRTP. Now you are talking about purchase from NRTP. Purchase from NRTP means recipient is any person. But now you are talking about recipient himself is NRTP, no credit. No credit except for IGST portion on import of goods. Not any IGST. IGST portion on import of goods. IGST portion on. Now this you need to understand with this particular understanding that the persons can be regular taxable person, casual taxable person, composition taxable person or NRTP, correct? If it is regular taxable person or casual taxable person, normal scenarios you will enjoy all the credit. Normal scenarios enjoy all the composition taxable person, normal scenarios no credit. You will enjoy all the credit. There is only one exception here. Except purchase from composition scheme dealer, no credit. Correct? And for composition taxable person, no credit. No exception. No credit. No exception. But if you are talking about NRTP, now the recipient is NRTP. Normal answer is no credit. Exception. IGST portion on, not IGST credit, IGST part of customs duty on import of goods, you will take the credit. If the recipient is RTP or CTP, generally full credit, except for the purchases from composition scheme dealer. If the recipient himself is composition taxable person, he will not get any single paisa credit. If the recipient is NRTP, normally no credit except IGST portion on input of goods. IGST portion on import of goods. And the last point of block credit, CSR expenses. Corporate social responsibility expenses under section 135 of your Companies Act. CSR expenses. If a company is spending on CSR expenses, corporate social responsibility expenses, it cannot take the credit. It cannot take the credit. It cannot take the credit. If a company is spending on corporate social responsibility expenses, be it goods or services, it cannot take the credit. It cannot take the credit. Are you guys clear with this understanding? Are you guys clear with this understanding? So how we divided your block credit? 4 parts. Motor vehicles, aircraft vessels, personal usage items mainly for employees, goods or services used for employees. First is motor vehicle category, second is employee category, third is immovable property category, last is miscellaneous. Last is, now this will make your job simple so that you can easily remember all the block credits. What is the speciality of all these block credits? If you, generally how you will get the credit, how you will get the question in your exam paper, you will get say 5-6 items in your exam paper, out of which 2 items are blocked. For these 2 items, you don't even think of condition. Answer is balance 3-4 items. You can take the credit on satisfaction of, then you have to check those conditions, whether the condition is satisfied or not. Whether the condition is, and you are not going to check totally 11 conditions. Real time you will check only 9 conditions. 2 conditions will be checked later. So question will not be dealing with those two questions, those two conditions. It will be dealing only with the 9 conditions. Check those conditions. If all the 9 conditions are satisfied for each of these points, take the credit. Out of totally there are 6 points. 2 point block credit, 0. Balance 4 points. Out of balance 4 points, 2 points. Conditions are not satisfied. You cannot take the credit now, you may take later. You may take balance 2 points. Not block credit. Conditions are satisfied now. You will finally take the credit in that month itself. In that month itself. That is how you have to work out your question. That is everything about your availment of credit. Actually, availment of credit is fully discussed when you discuss block credit with conditions. First step is block credit with conditions. So first step should always be block credit, not the conditions. Not the conditions. Now when you talk about the concept of proportionate credit, which is again given within section 17. What is the concept of proportionate credit? See, please understand, always you will not get full credit. Assuming that I am dealing with multiple products, one being taxable, one being exempt. Right? I will not get full credit. Now there are certain input services, capital goods, which are used only for taxable outward supply. I will get full credit. There are certain input services, capital goods, which are only used for my outward supply, which is exempt. Outward supply, which is exempt. If I am paying output tax, take credit. If I am not paying output tax, no credit. But there will be certain common items. There will be certain common items. So if at all I am having 2 outward supplies, outward supply 1, outward supply 2. There are input service, capital goods 1. Capital goods 1. There is input service, capital goods 2. Now my outward supply 1 is taxed at 18%. Outward supply 2 is taxed at 0%. What is the thumb rule for me to take the credit? What is the thumb rule for me to take the credit? If I am paying output tax, I can enjoy input tax credit on input 1, input service 1, capital goods 1. If I am not paying output tax on output supply 2, on related input service, capital goods, there will be GST on my purchase invoices. But I cannot take the credit, it will be added to my cost. But there will be certain common input service, capital goods 3, which we will call as commonly used for both. What will happen for this common items? What will happen for this common items? I cannot tell that I will take full credit. I cannot tell that I will not have any credit. So here comes the concept of proportionate credit. I'll have the credit but not fully. I'll have the credit but not fully. Clear? The concept or the logic of proportionate ITC. Proportionate ITC. And it is not only for your outward supply being taxable and exempt. This could be even true for your outward supply is taxable, but plus it is only and only for business purposes, or outward supply 2 is exempt, or it is for non-business purposes. Input service 1, capital goods 1 used only for business purposes, take full credit. Input 2, input service 2, capital goods 2 used only for non-business purposes, no credit. But there are certain common input service, capital goods 3, which are used for business as well as personal purposes, non-business purposes, proportionate credit. Proportionate credit. So that's the logic of your proportionate credit. Proportionate credit. So when you can enjoy full credit? When you can enjoy full credit? Only when it is used only for outward supply which is taxable, plus only for business purposes. Only in that scenario, full credit. Only in that scenario, and which was given in this example. Only for outward supply which is fully taxable, and only for a case where it is fully used for business purposes. Only in that case, full credit. If it is used for an outward supply which is exempt, or now it is not and, it is or, it is used for non-business purposes, no credit. If there is something common, certain categories of input services, capital goods used for both outward supply which is taxable and outward supply which is exempt, proportionate credit, or common input services, capital goods which is used for both business purposes and non-business purposes, there is nothing but proportionate credit. Proportionate credit. See, this entire proportionate credit is discussed in your rule 42, 43. 42, 43. But for banking sector, you have a special rule. Generally, what is the rule? Rule 42, 43. For banking sector, you have a special rule, rule 38. General sector, including banks, rule 42, 43. This rule 38 is only for banking sector. Only for banking sector. Now we are first focusing on rule 38. Rule 38. Understand the complicated calculations are there in rule 42, 43. Rule 38 is a very simple calculation. Very, very basic and simple calculation. Basic and simple calculation. Understand this way. If at all you are having proportionate credit, in general you have only one route, 42, 43 route. Rule 42, 43 route. If you are there as a banking sector, you have two routes. Either go for the complicated rule 42, 43 or go for simplified rule 38. So this banking sector, when I tell banking sector, it is banking company, financial institution and non-banking financial companies. For them, either go for 40 to 43 or go for simplified. This option 2 is simplified rule 38. But once you exercise the option, it cannot be withdrawn during the remaining part of the year. Once you exercise any option, 40 to 43 is by default option. Rule 38 is a simplified option. Once you go for a simplified rule, you have to be there till the end of the year. You cannot again go back. Whether this route is there for others? For others, no. For others, you have only one route, which is rule 42 for inputs and input services, 43 for capital goods. So it's only one door. Rule 42, Rule 43. For banks, either Rule 42, 43 or Rule 38 or Rule 38. So when you talk about banking sector, we talk about banking sector. Alright. Which rule is governing it? Rule 38. Rule 38 can be read as 3 B's. Correct? If you use your calculator and if you press 3 and 8, it will be read as 3B. Correct? 3B. So banking sector, 3 B's. What are the 3 B's of banking sector? First, blocked. Second, you're talking about the balance category. And third, you're talking about branch to branch. So first, you're talking about block category. This is the last final leftover portion, balance category. This is branch to branch category. Nothing but distinct persons. Nothing but distinct persons. If it is blocked category, blocked category, no one will get the credit. Even banks will not get the credit, even under simple scheme. No one will get the credit. Block credit means no one will get the credit. Block category, we have seen. What is the block category? No one will get the credit. Branch to branch, distinct person. Mumbai branch of a bank is providing services to Bangalore branch of another bank. So we are talking about Bangalore branch. Mumbai will pay output tax. Bangalore will take credit, 100% credit. Balance category, 50%. That's it. If at all banks or financial institutions or non-banking financial company decides to ignore the complicated rule 42, 43 and go for simplified rule 38, their life is very simple. And this is actually applicable for all. It's not only for inputs and input services, it is applicable for inputs, input services and capital goods, everything. So what you have to do? You have to bifurcate. Take your input services, capital goods, see if it is blocked, 0. Second, see if it is branch to branch, that is distinct person, take 100%. Balance, leftover portion, everything, 100, leftover portion, everything, 50%. Leftover portion, everything, 50%. So if at all by any chance you get this question, you will be the luckiest person, because the questions will be in such a way that you have certain input services, capital goods, which are non-business purposes or blocked. Non-business is included in block credit. Block credit, input taxes 2000, but credit will be 0. Next, you're talking about branch to branch. One branch, head office is giving to the branch office. Branch of a bank giving services to branch of the same bank. We are talking about the recipient branch. What will be the answer? What will be the answer? Input taxes 1000. You'll get 100%. So here it is 0% credit. Here it is 100%. All the balance supplies. All the balance supplies. What will be the answer? What will be the answer? You'll get input taxes. Input tax, this GST treated as input tax. GST on the invoice is nothing but input tax. Now here you can differentiate meaning of input tax and input tax credit. Correct? There is input tax on my invoice, but I don't get entire credit. So how much credit I'll get? 7,000 multiplied by 50%. So what is the total credit that I'll get? 4,500. 4,500. A very, very simple and efficient way to remember your banking sector proportionate credit. And see the coincidence. Banking sector B, 3 B's. 3 B's, 38 is the rule number. Rule number also coincidentally is 38. Right? Blocked, balance. Obviously, it is not called as branch to branch, but distinct person nothing but one branch to another branch. Branch to branch. Block 0 for everyone, even 0 here. Branch to branch 100%. Leftover category. Balance 50%. Balance. There cannot be any simple question in input tax credit other than this. Right. So that is all about your proportionate credit for Banking sector. They have two doors, complicated door 42, 43 or simplified door rule 38. Once they select rule 38, they have to be there in rule 38 till the end of the financial year. Then they can again switch over. Why banks have proportionate credit? What is the main income of bank? What is the main income of bank? Interest on loan exempted. What is the other income of bank? Processing fees, documentation charges, NEP charges, RTGS charges, checkbook issuance charges, etc., etc., etc. That is all taxable. So one stream is exempt, one stream is. So they'll have common input services, capital goods, where there'll be proportionate credit. Where there'll be proportionate credit. Clear? Clear? Where there'll be proportionate credit. So that's everything about your banking sector special rule, rule 38. Now you're talking about section 18. Section 18, which talks about ITC in special circumstances. Please understand the fact that when you're talking about ITC in special circumstances, we are talking about scenarios which will not happen in general. Very rare occasions you'll find them. Very, very rare occasions you are going to find them. ITC in special circumstances. Now let us try to understand this ITC in special circumstances. The first part of it. You're talking about some switchover. You're talking about some switchover. Supposing you're earlier there under your composition scheme, now you're switching over to regular scheme. Or earlier your outward supply was exempt supply, now it becomes taxable supply. Or earlier you are not registered, now you're going to get registered. Now when you're going to get registered, there are two possibilities. Either it is a case of voluntary registration or you're liable for registration. If you're liable for registration, you should have applied within. If you don't apply within 30 days, this benefit is not available. This 30 days is very crucial in registration chapter, and it's not only in registration chapter, it is connected in ITC chapter, it is connected in return filing chapter, it is connected in many other chapters. This 30 days, crucial factor. 30 days is very, very crucial factor. Even document chapter, for that matter, revised tax invoice. So 30 days is very, very crucial. If you're liable, you should have applied for registration within 30 days. You should have applied for registration within 30 days. Now, what is the exact opposite scenario? Exact opposite scenario. Regular scheme to composition scheme. Taxable supply, exempt supply. You are registered, now you are cancelling your registration. Correct? This could be the exact opposite scenario. Supposing this event happens on 1st of October and this event happens on 1st of April. What will happen? Now please understand that in the first scenario, both are actually mirror image. You're just converting them into opposite. Correct? What will happen in the first scenario? Earlier you were not eligible for taking the credit. Correct? Because either you are under composition scheme, or your outward supply was exempt supply, or you are not registered. In all the three cases, you are not eligible for input tax credit. Now you are eligible for ITC. Correct? Because you are under regular scheme, your outward supply is taxable supply and you are registered. And in the reverse case, earlier you are eligible for ITC because you are under regular scheme, outward supply is taxable supply and you are registered. And later on you will not be eligible because you are under composition scheme, or your outward supply becomes exempt supply, or you are cancelling your registration. Now the issue is not about what is going to happen in future. The issue is all about stock. On the date of conversion, there will be some stock. Correct? There will be some stock. Here it is stock as on 30th September and here it will be stock as on 31st March. Correct? The previous date stock. And whenever I tell stock, it is very clear that it is only inputs and capital goods. You cannot have stock of services. Correct? It is only in inputs and capital goods. What are you going to do with stock of inputs and capital goods in the first case? You did not take the credit earlier, but now you are eligible for taking the credit on the stock. What you will do? You will avail the credit because of the stock which is there. You did not take credit earlier. Earlier you are under composition scheme, or your supply was exempt supply, or you are unregistered. But now you are under regular scheme. Outward supply is taxable supply. And you are registered. Because this stock, when it is going to be sold, you are going to pay output tax. So you are going to take the credit. What will happen in the reverse case? Earlier you were eligible for credit, you took the credit. But now onwards, you cannot take the credit because you have switched over to composition scheme, or your outward supply has become exempt supply, or you cancel your registration. So that is a stock on which you have taken the credit, but you are not going to pay any output tax later. Correct? So what to do? What to do? Reverse the credit. Are we guys clear with this understanding? Are we guys clear with this understanding? Now government is government. Government loves availment of credit, or government loves reversal of credit? Government loves availment of credit, or government loves reversal of credit? Now you will see the real cases of the government. So easy to remember. When you are availing the credit, in two cases you can avail the credit of inputs and capital goods, but in case of new registration, you can avail the credit only of inputs, not of capital goods. In the first two cases, composition scheme to regular scheme, inputs and capital goods. Exempt supply to taxable supply, inputs and capital goods. But when you are taking new registration, you can take the credit only of inputs, not of capital goods. So obviously, if you understand this, in the reverse scenario, when you are cancelling your registration, what should happen? You should reverse on only inputs, not on? No. Reversal in all the three cases is on inputs and capital goods. See, when it is reversal in all the three cases, see, left hand side you have three cases, right hand side you have three cases, correct? Left hand side you have three cases, right hand side you have three cases. When it is the availment, in the first two cases, you can avail on inputs and capital goods. In the last case, registration, you can avail only on inputs. When it is reversal, in all the three cases, so I'm not only talking about cancellation of registration, in all three cases, you have to reverse on inputs and capital goods. So then why have I written only cancellation of registration? Because we are only comparing registration. Because we are only comparing registration. If I were to tell in a very simple manner, when you talk about availment here is on inputs and capital goods. And availment here is only on inputs, not on capital goods. Whereas reversal in all the three cases is on inputs as well as capital goods. Reversal in all the three cases is on inputs and capital goods. Clear? First difference. Government doesn't stop here. Government tells if you are availing the credit, you can avail the credit only on last 1 year old stock. If the stock is more than 1 year old, forget about the credit. Supposing I have 1 lakh stock, out of which 80,000 is last 1 year, 20,000 is older than 1 year. Then I can take the credit only on 80,000 units, not on 20,000 units. But when it is all about reversal, whether the stock is 1 year old or not is not alert. If it is 1 lakh stock, 80,000 is last 1 year old and 20,000 is more than 1 year old. You reverse on entire 1 lakh, and this 1 year is relevant for both inputs and capital goods. Clear? Government doesn't stop here. When it is availment, if you want the credit, please come within 30 days plus extension. You come soon, 30 days plus extension. Come fatafat. Take the credit. If you're coming late, no credit. But if it is all about reversal, there's a time limit. But you're not bothered. You come within time, you come after time, no worries. If you're coming late, don't worry. We'll reverse it with interest. Government is telling that no worries. We'll take the reversal of ITC with interest. There they are very specific about the time limit. Come within 30 days plus extension. Otherwise, we'll not give you the credit. But reversal, in one case, it is 60 days. Whether you come or not in time for your regular scheme to composition scheme, it is within 60 days. Whether you come on time or not, don't worry. We will reverse it. If you don't come on time, we will reverse it with interest. We will take the reversal with interest. Wait, it doesn't stop here. When you talk about your availment. When you talk about your availment, government tells that if the value is more than 2 lakhs, we will go with CA, CMA certificate. If you're taking more than 2 lakh credit, we have a doubt. How can we trust you? You're taking so much credit. You're taking so much credit. We want CA, CMA certificate. But government tells that no. Whatever is the value, that is 2 lakhs or 10 lakhs or 1 crore or 2 crores. We don't want any CA, CMA certificate. We'll check ourselves. It's all about coming of money. We will check ourselves. If you have done wrong reversal, we'll collect that amount with interest. No need of CA, CMA certificate. No need of CA, CMA certificate. Are you guys clear with this understanding? Are you guys clear with this understanding? Right. So if you see these differences, conceptually it is the same. In the first case, it is all about availment of credit on the stock. In the second case, it is all about reversal of credit on the stock, correct? But there are certain differences, like in availment, when you are taking the availment of credit, in the first two cases, it is on inputs and capital goods, but in the last case, it is only on inputs. Whereas at the time of reversal, in all the three cases, reversal is on inputs and capital goods. When you're talking about availment, your stock should not be older than 1 year. It's all relevant for calculation part. But when you're talking about reversal, whether it is old than 1 year or not, this 1 year criteria is not at all considered. Whether it is more than 1 year old or not, we are not even bothered. We are not even, whether it is within 1 year or more than 1 year, you have to reverse on entire thing. But it's all about availment. You come fast, come within time, 30 days plus extension. Otherwise, you will not get the credit. But when it is all about reversal, whether you come in time or not, you have to reverse it. If you're coming late, reverse it with interest. When it is all about availment, if the amount is more than 2 lakhs, we don't trust you. You come along with CA, CMA certificate. Reversal. Whatever is the amount, 2 lakhs, 10 lakhs, 2 crores, 10 crores. No need of CA, CMA certificate. We will check ourselves. We will check ourselves. And if you think the difference stops here, it is not. Think of reversal of credit. I am now only focusing on reversal of credit because this will be workable only in reversal of credit. Supposing you have to reverse the credit of 10 lakhs. You have to reverse the credit of 10 lakhs. Already in your credit ledger, you have 8 lakhs. See, obviously, understand that it will not be only one line working, it will be IGST, CGST, SGST. But I am making the concept simple. Always, whenever it is set off and all, it will be IGST, CGST and SGST. This is the first scenario. Second scenario, you have to reverse ITC of 10 lakhs. And in your credit ledger, there is, say, 13 lakhs. Now, what happens in the first case? You have to pay 2 lakhs by cash ledger. Correct? Here, what is the amount that you will pay by cash ledger? You have to pay 10 lakhs. You already have in credit ledger 13 lakhs. You have to pay nothing by cash ledger. Rather, 3 lakhs you will have balance amount in credit ledger. But government tells what you will do? Give that also. Give that also. That will lapse. That will lapse. See, understand that if at all, forget about the last case, cancellation of registration. In cancellation of registration, lapsing is fine. But in other two cases, if I would have had this credit, it would have been used later point of time when I again convert from composition scheme to regular scheme. Or when my again supply becomes exempt supply to, it would have been of some use to me. Government is government. It will lapse. It will lapse. In availment, this situation doesn't come. So availment is all about taking to credit ledger. In reversal, this will come. So in reversal, apart from these differences, even this is a very disturbing point. If I have to pay 10 lakhs, I have 8 lakhs in my credit ledger, then you ask 2 lakhs in cash. But in a reverse scenario, if I have to pay 10 lakhs, reversal of ITC, I have 30 lakhs in my credit ledger, payment by cash is 0. That's okay. But extra credit, 3 lakhs will lapse. Will lapse. Clear? So that is this particular point. And the last difference is the capital goods calculation. Here, there's an extra point. What is that extra point that you discussed in reversal? What is that extra point that you have discussed in reversal? The concept of lapsed ITC. I have to explain with example. Now you know that that's the concept of lapsed ITC. Then that's the final difference between availment and reversal. Capital goods calculation. Capital goods calculation. Now, supposing you have a capital goods on which GST portion, I'm not talking about the price, I'm talking about the GST portion is 1 lakh. Rather, we'll take only say 1 lakh. This is the GST portion. This you have purchased on say 10th of June 2024. 10th of June 2024. Now let us take two scenarios. Here we are talking about switching over from composition scheme to regular scheme. Composition scheme to regular scheme. Availment of credit. Here you are talking about say your taxable supply becomes exempt supply. So this is all and all about your availment of credit, correct? And this is all and all about your reversal of credit. And this conversion happens on say, we'll keep a date. This conversion happens on say 1st of January 2025. 1st of January, rather, will be more logical. We'll keep say 6th of Feb 2025. 6th of Feb 2025. Now, how much credit you will avail? Availment goes with subtraction method. Your availment of credit goes with subtraction method, and your reversal of credit goes with multiplication method. Both are different. Now, subtraction method is what? What is the availment of credit that will happen here? Availment of credit is 1 lakh minus 1 lakh multiplied by 5% multiplied by number of quarters. Subtraction method is based on quarters. It's based on quarters. So your availment of ITC is 1 lakh subtracted by 5% per quarter or part thereof. 5% per quarter or part thereof. How many quarters? How many quarters? Is it 3 quarters or 4 quarters? Quarters always signifies calendar quarters. Obviously, if you calculate, you will get 3 quarters. If you do normal calculation, you will get 3 quarters. 10th June means 10th September. Then your 10th June to September, December. Then it will somewhere end in March. But you will get only 2 point some quarters, correct? But it's the wrong answer. Because quarters always means calendar quarters throughout GST law. Anywhere in GST law. So your 10th June to 30th June is 1 quarter. Calendar quarter. Calendar quarter will end on June. Then your 1st July to 30th September is 2nd quarter. Then 1st October to 31st December is 3rd quarter. Then 1st Jan to 6th Feb is another quarter. So total number of quarters 4. If it is flexible quarters, you would have answer as 2 point something, which is 3. Because part of the quarter means anything is 3. 2 point something is 3. But here it is calendar quarter. You see calendar quarter, first is part of the quarter, but you treat it as 1. And the last quarter is also part of the quarter, but you treat it as 1. Calendar quarters always ends at June September, December and March. That is calendar quarter. 10th June to 30th June is treated as one quarter. 1st Jan to 6th Feb is treated as one quarter. Part of the quarter which is one quarter. So how many quarters? How many quarters? So normally you would have got 3 answers, but now it is GSC means calendar quarters. GSC means calendar quarters. So what will be the answer? 20% will be subtracted. So what will be the answer? What will be the answer? 80,000. Correct? But when you talk about your reversal, it is multiplication method, and multiplication method is based on months. M. Multiplication method is based on months, and it is not calendar months. It is not calendar months. Now how to calculate here reversal? Reversal is 1 lakh multiplied by balance life in months divided by 60. See, it is always assumed that capital goods life is 5 years. Even in subtraction method, because after 5 years, you will subtract entire 100%. 1 year, 1 quarter, 5%. So 1 year, 20%. 5 years, 100%. 5 years. Here also it is taken as 5 years only, but you calculate in months. So divided by 60 months. What is the balance life in months? What is the completed life? Completed life. How many life is what is the completed life? 10th June to 6th Feb. 10th July, 10th August, 10th September, 10th October, 10th November, 10th December, 10th Jan, 10th Jan, 10th Jan. So which means 7 months and 26 days. Correct? 7 months and 26 days. Whether it is 7 months 2 days or 7 months 26 days, it will be treated as. Whether it is 7 months 2 days or 7 months 26 days, it will be treated as 8 months. I repeat, whether it is 7 months 26 days or 7 months 2 days, it will be treated as 8 months. So what is the balance life? What is the balance life? 60 months minus 8 months. What is the balance life? What is the balance life? Sorry, 50. 60 months minus 8 months. What is the balance life? 52 months. So what you will take? 52. 1 lakh multiplied by balance life divided by 60. How to find balance life? First find completed life. What is the completed life? 7 months, 26 days. Whether it is 7 months, 26 days or 7 months, 2 days, it will be taken as 8 months. July, August, September, October, November, December, Jan. 7 months. Then till Feb, 26 days. So whether it is 7 months, 26 days or 7 months, 2 days, it will be taken as 8 months. So what is the balance life? Entire life is 60 months. So what is the balance life? 60 minus 8, 52. Take that. What will be the answer? 1 lakh multiplied by 52 divided by 60. 1 lakh multiplied by 52 divided by 60. 86,000. You'll find that you will never get the same answer. When you are availing the credit with the same data, I have taken the same data, same dates, everything same data. Everything, the dates and the numbers are exactly the same. Situation is different. What is the situation in the first case? Composition scheme to regular scheme availment. Taxable supply to exempt supply reversal. But answer is different. Availment goes with subtraction method based on calendar quarters. Tax amount subtracted by tax multiplied by 5% multiplied by number of quarters. Number of completed quarters. Quarter is calendar quarter. Quarter is calendar quarter. And reversal goes with multiplication method, normal months, not calendar months. Normal months, not. So normal months calculation you do. What is the formula? Tax multiplied by balance life divided by 60. How to find balance life? First find completed life. If the completed life is 7 months, 2 days or 7 months, 26 days, it is 8 months. Balance life is 60 minus 8, 52. You'll get a different answer. Are you guys clear with this understanding? Are you guys clear with this understanding? So this is the last difference when you talk about your availment and reversal. Now there can be actually 4 situations here. There can be actually totally 4 situations arising here. 4 situations arising here. What are the 4 situations arising here? One, you're talking about taking new registration. Rather, first we'll make it simple. One, you're talking about switching over from composition scheme to regular scheme, or your exempt supply becomes taxable supply. Ulta, regular scheme to composition scheme, your taxable supply becomes exempt supply. This is all about availment of credit, and this is all about reversal of credit. When you are availing the credit, you are availing on inputs and capital goods. When you are reversing it, inputs and capital goods. Inputs and capital goods. But when you are seeing inputs, if I tell totally 1 lakh stock of inputs is there and 80,000 is within 1 year old. It is within 1 year old, and 20,000 is more than 1 year old. What you will do when you are availing on inputs and capital goods? When you are availing on inputs, you will avail only on 80,000 units. But when you are reversing it, you will reverse on 1 lakh units. You will reverse on 1 lakh units. And when you are availing the credit on capital goods, you will go with subtraction method. When you are doing for capital goods for reversal, you will go with, and we have seen the calculation of subtraction method and multiplication method. But the only thing that you have to take care, that even for inputs as well as capital goods, you have to take care of 1 year. If the capital goods is more than 1 year old, you will not get it. The same way, if inputs is more than 1 year old, you don't get it. The same way it's true for capital goods. But when it's all about reversal, when it's everything about your reversal, what will happen? In reversal, you will ignore 1 year old. Whether it is within 1 year old or more than 1 year old, it's not relevant. It's not relevant. You will not take care of 1 year old. Just like inputs, correct? Did you take care of 1 year old? For inputs, did you take care of 1 year old? What are the inputs here in the question? What are the inputs given in the question? How much quantity of inputs you had? On the conversion date, how much quantity of inputs you had? On the conversion date, how much quantity of inputs you had? You had 1 lakh units, out of which 80,000 units were more than 1 year old and 20,000 units were 80,000 was within 1 year old and 20,000 was more than 1 year old. So when you are availing it, you take care of 1 year, not only for inputs but also for capital goods. You have to take care even for capital goods. But when you are reversing it, you don't even bother. You don't even bother. So why you did not take, why you took only composition scheme to regular scheme, exempt supply to taxable supply, or regular scheme to composition scheme, taxable supply to exempt supply? Because when you take new registration or when you cancel your registration, that's the difference. When you take new registration, you will work out only for inputs, you will not work out for capital goods. Again, the answer will be the same for 80,000 units. Again, you will consider 1 year for only inputs, because anyways you cannot take for capital goods. But when you are reversing it, you will reverse both for inputs and capital goods. And when you are reversing it, you will not even bother about 1 year. You're least bothered about your 1 year criteria. So when you're reversing it, you will reverse on entire 1 lakh units for inputs, and for capital goods, you will not see the date and all, you will do it. But which method? Not only that, and the last nail on the coffin, last point on the coffin, everything else. And actually, this was actually very clear. I've just given different types of questions. So there can be 4 types of questions. These 2 things are dealing with availment of credit, correct? But for registration, only on inputs, not on capital goods. And this side, these are dealing with, these 2 on the right hand side are dealing with reversal of credit. These 2 on the right hand side are dealing with reversal of credit. So then why you have given reversal of credit in 2 parts? Because reversal of credit, whether it is regular scheme to composition scheme or exempt supply to taxable supply, or cancellation of registration is the same? No. Here in the last part, there is a clear-cut difference. This will be the first part of the answer. You will compare it with output tax payable on deemed supply. Second part of the answer, whichever is higher. Cancellation of registration. First part of the calculation, whatever you have done earlier will work out. But that is only one part of the answer. That is only why VJ Limited registered is different from VJ Limited which is not registered. And the stock that is going to be transferred is deemed supply. This is deemed supply. So one part you will do the calculation for reversal of ITC in the same manner. Exactly same manner. For inputs on the entire stock, entire 1 lakh units, whether it is within 1 year or more than 1 year, it will reverse. For capital goods, 1 year or more than 1 year old, you will reverse, but with multiplication method. So that will be only first part of the answer. Then you will take the entire stock. Now you will not treat it as inputs and capital goods. You will treat it as goods. You will treat it as goods. You will not treat it as inputs and capital goods. You will treat it as goods, and you will think that you have sold it. Deemed supply. You will think that you have sold it. You will have to find deemed valuation. Valuation rules will come into picture because actual supply is not that, it is deemed supply. Some notional value will be applied, and on that you will pay output tax on the deemed supply. That will be the second part of the answer. Believe me, this first part and second part will never be the same answer, because one is based on calculation of your ITC and one is based on calculation of your output tax. Calculation of your whichever is higher. Whichever is higher. ICAI till date has not touched this last part, where you're talking about cancellation of registration, because ICAI has touched only the basic part. Cancellation of registration, and in cancellation of registration, you have to work out two things. One is reversal of ITC, which is the same. Inputs and capital goods, both for both inputs and capital goods, whether it is within 1 year or more than 1 year, you have to do reversal. For capital goods, there's a multiplication method that we have understood. You will get a number. Adding both, you will get a number, but that is not the final answer. That number has to be compared with output tax payable on deemed supply. Because now you will not treat them as inputs and capital goods. You will treat those goods are being sold. Those goods are being, assume that they are being sold, deemed supply. You will have to take the help of valuation rules. You will get a value of both inputs and capital goods, because they are not now inputs and capital goods. They are actually goods which are being supplied. Goods which are being supplied. Get a value and the rates on them. That question will be giving you what is the deemed value, deemed supply valuation, and what is the deemed supply rate of tax. You will multiply them. You will get an output tax payable on deemed supply. That is the second part of the answer. Compare both, whichever is higher. Whichever is higher. Now, if you look at all the 4 possibility of questions, you'll have an understanding that registration, not only for availment of credit it is special, but also cancellation of registration is special. Availment of credit at the time of new registration, you will get the credit only on inputs, not on capital goods. Cancellation of registration, when you talk about reversal, it will be reverse on inputs and capital goods. 1 year is not relevant. Capital goods multiplication method, but that is only one part of the answer. Compare it with output tax payable on deemed supply as per schedule 1. That is second part of the answer. Whichever is higher. Whichever is higher. So that area will be that. That area will be that. So that completes everything about your section 18 first 2 parts. We are not done with entirely section 18. The section 18, the first 2 parts which is given in this entire page, we have discussed. When you revise it, this page will be very helpful. When you have all the clarities, this page will be very, very helpful. Now, we are talking about other special cases of section 18. Other special cases of section 18. One being sale of capital goods. One being supply of capital goods, including plant and machinery. Actually, capital goods includes plant and machinery. It was not required. Supply of capital goods on which ITC is availed. Now, in general, the answer is very simple. See, sale of capital goods is outward supply. If I am selling a product, how to calculate tax? Just give me a method of calculating tax. Take the price, take the rate, calculate it. Correct? Take the price, take the rate, calculate it. So one part of the answer is very simple answer. Tax on transaction value. When I tell tax on transaction value, it is nothing but assessable value multiplied by rate of tax. It is nothing but selling price multiplied by rate of tax. Take the selling price of capital goods multiplied by the rate of tax. But that is one part of the answer. Compare it with depreciated ITC. What is depreciated ITC? We already discussed for your availment of credit. Depreciated ITC subtraction method. ITC subtract by 5% per quarter or part of the quarter. Compare both and find whichever is higher. One of the favorite area of ICI. In section 18, if I were to tell what is the most important thing, this is the most important thing. Compare both, whichever is higher. If I were to give a number on 10th of June, you have purchased a capital goods. You have purchased a capital goods for say 10 lakh plus GST 1,80,000, which means 18%. Which means 18%. On 3rd of January, you are selling it for 6 lakhs. You are selling it for 6 lakhs. This is all about your purchase. This is all about your sale. Calculate the output tax payable. How to calculate it? On sale, you are going to make the payment. What is the sale value? 6 lakhs. What is the rate of tax? 18%. What is the amount that you will get? 6 lakhs multiplied by 18%. What is the tax that you are going to get? 1,08,000? 1,08,000. 1,08,000. But this is not the final answer. This is tax on transaction value. Compare it with what? Comparison will be with what? What is the ITC? 1,80,000 subtracted by 1,80,000 multiplied by 5%. Multiplied by how many quarters? The quarter starts from June to Jan. So June will be one full quarter, correct? June will be one full quarter. 10th June to 30th June, one quarter. 1st September to 31st December. I'll write it as 2 quarters. 2 quarters, correct? Sorry, no, 1st July to 31st December. I'll write it as 2 quarters because there are 2 quarters. 1st July to 30th September, then 1st October to 31st December. Then 1st Jan to 3rd Jan will be one part of the quarter. 1. So 1 plus 2 plus 1. How many quarters? So what is the subtraction that you'll do? 20%. You subtract 20%. Now if you subtract 20%, you're going to subtract 36,000. So 1,80,000 minus 36,000. 1,44,000. Now which is higher? That's it. Whichever is higher. Whichever is higher. Are you guys clear with this understanding? Right. So this is for sale of capital goods, including plant and machinery. But what if there are special capital goods? Very simple answer. If at all there are special capital goods like refractory bricks, molds, dies, jigs and fixtures, all these items are used in job working sector. Refractory bricks, molds, dies and jigs and fixtures, condition number 1. And if they are sold as scrap. Special capital goods when they are sold as scrap. You forget the complications. No subtracted ITC and all. Forget entire complication. When I sell an item, how to calculate tax? Assessable value multiplied by percentage. So it is nothing but tax on. See what is the difference? Now you don't enter into that complication of One part tax on transaction value, second part ITC minus something, compare whichever is higher. If it is special capital goods, refractory bricks, molds, dies, jigs, fixtures, plus when they are sold as scrap. When they are not sold immediately when they are purchased. When they are sold as scrap, which means fully utilized. Fully utilized. What to do? Take the selling price, multiply it with the rate. That's a tax on transaction value. Tax on transaction value. Tax on your transaction value. Are you guys clear with this understanding? Are you guys clear with this understanding? That is your supply of capital goods. Supply of your capital goods. Normally, this will be the answer. Tax on transaction value or depreciated ITC, whichever is higher. But it is special capital goods. Refractory bricks, molds, dies, jigs and fixtures. And when they are sold as scrap. When they are sold as scrap. It is just tax on transaction value. That is assessed value multiplied by percentage. That's it. Selling price multiplied by the percentage. That's only simple way out. Clear? Right. So we have seen three special cases of your ITC. This will never happen routinely. The conversions will not happen routinely. Sale of capital goods is not a routine affair. And the last part of your section 18. The last part of your section 18. Now what is happening in your last part will make your life simple. It's all about your rule 41, rule 41A. What is happening in your last part? Supposing if I tell VJ Limited is selling the business to PJ Limited, or that is VJ Limited and PJ Limited, which gets merged into say VP Limited, or that is VP Limited, which gets demerged into VJ Limited and PJ Limited. You're talking about normal sale or transfer of business, merger or amalgamation, demerger. Correct? Correct? This is the case of sale or transfer of business. This is the case of merger or amalgamation. This is the case of demerger. This is the case of demerger. Now, what if I add point to it? VJ Limited in its electronic credit ledger is having 10 lakhs. In the second case, VJ Limited in electronic credit ledger is having 20 lakhs and PJ Limited is having 30 lakhs. In the third case, VP Limited in its electronic credit ledger is having, say, 50 lakhs. Please understand that. Can you apply for refund of your credit? No. Only possible in two cases. What are they? Zero rated supply and inverted duty structure. Otherwise, you cannot apply for refund of credit. Now, all these left-hand side companies are going to wind up. So, having credit with them is of no use. Can they transfer it to the new companies? Can they transfer it to the new companies? Yes, they can transfer it to the new companies. So now they're talking about possibilities of transferring it to the new companies. So that is a transfer which is going to happen. So you're talking about transfer to the new company. This is also transfer to the new company. This is also transfer to the new company. What will be the amount transferred to the new company? In the first case, VJ Limited is having 10 lakhs. How much it can transfer? 10 lakhs. In the second case, what will be the amount of transfer? Both VJ Limited, PJ Limited will transfer. So what will be the amount? 20 lakhs plus 30 lakhs. It will be 50 lakhs. In the third case, 50 lakhs is to be given between VJ Limited and PJ Limited. So 50 lakhs multiplied by something divided by something, correct? 50 lakhs multiplied by something divided by something. Got that? Now that will be 50 lakhs multiplied by something divided by something. Now what is that multiplied by something and divided by something? In what proportion? In the proportion of value of assets being transferred. Value of assets being transferred. In the first two cases, simple calculation. Simple calculation. In the last case, you require a proportion because now it will be split. One between VJ Limited and one between PJ Limited. That proportion will be on the basis of value of assets transferred. Supposing the value of assets is 100 crores with VP Limited and it is transferred 40 crores to VJ Limited and 60 crores to PJ Limited. It will be transferred in the ratio of 4:6 or maybe 2:3, whatever it is. Same answer only. So 4 divided by 10, 4 divided by 10 and 6 divided by 10. So how much it will get? This will get 20 lakhs and this will get 30 lakhs. So in the last scenario, you do require value of assets being transferred. And what if I tell that out of this value of assets 100 crores, only 70 crores has got ITC. Out of total assets 100 crores, only 70 crores has got ITC, and that 70 crores portion, only if I take the ITC availed assets, it is 70 crores, and that is equally given 35 crores and 35 crores to VJ Limited, PG Limited. Whether your answer will change or it will remain the same. Out of this 100 crores, only 70 crores assets is there where ITC is available, and that 70 crores is split in the ratio of 35 crores, which means 35 crores ITC where ITC is availed and 5 crores where ITC is not availed to VJ Limited, and 35 crores where ITC is availed and balance 25 crores where ITC is not availed. Correct? It is possible. So whether your answer will change? No. The ratio is total value of assets. Now this is the area where students will make mistake. Why? We are talking about transfer of credit. And what seems more logical? What seems more logical? What seems more logical is value of assets on which? No, but this is not at all relevant. Value of assets on which ITC is available is not relevant. Value of total assets is relevant. Value of? So otherwise your ratio would have been 1:1. Your ratio would have been 1:1, which means 25 lakhs would have been transferred. But no. When you talk about value of assets, value of assets means all the assets, whether ITC is availed or not. And if this is not said, a question can be easily drafted by ICI telling that total assets transferred is 100 crores in the ratio of 40 crores to 60 crores. But out of that 100 crores, only 70 crores contains ITC, and that 70 crores distribution happens in the ratio of 35 crores and 35 crores. The second data is irrelevant. You have to take value of total assets. Are you guys clear with this understanding? And in all the three cases, whatever are the three cases, in all the three cases, there is a condition, common condition. When you want to transfer the credit, there is a condition. First condition, there should be transfer of liabilities. If you want to transfer the credit, there should be transfer of liabilities. In the first case, VJ Limited to transfer all the liabilities to PJ Limited. In the second case, both VJ Limited and PJ Limited's liabilities should be transferred to VP Limited. In the third case, VP Limited liabilities should be jointly and severally transferred to VJ Limited and PJ Limited. Second condition, irrespective of the amount being transferred, no 2 lakhs and all, irrespective of the amount being transferred, they do require CA-CMA certificate. In all these three cases, the transfer of credit will be allowed from the old company to the new companies, from the old entities to the new entities. Condition number one, the old entities should transfer all the liabilities to the new entities. Condition number two, this transfer, there will be filed, there will be a document which is going to be filed, ITC form will be filed by the old entities, and thereafter the new entities will get the credit. So old entities will file a ITC form. That should be certified by CA, CMI. CA, CMI. Are you guys clear with this understanding? Are you guys clear with this understanding? This is all about in rule 41. 3 cases. Then they introduce 41A. 41A is similar to demerger. So what is 41A? 41A, let us assume that you are talking about VJ Limited in Tamil Nadu. First operating with only one registration. Now decides to go for re-registration. Opting for multiple registration in the same state. Opting for multiple registration in the same state. Optional multiple registration. Optional same state. So VJ Limited is there in Tamil Nadu, now also there in Tamil Nadu. Earlier working with one registration, now working with 3 registration. And I've presented the picture that it is just like demerger. It is just like demerger. The only differences. Now let us focus on the differences. There is no condition of transfer of liabilities. There is no condition of CMA certificate. There are no conditions. Why? Liability remains with VJ Limited. Whether it is registration 1 or 2 or 3, company is the same. So liability remains with VJ Limited. Second, what is the use of CA/CMA certificate? After all, credit is being transferred from one registration of VJ Limited to other registration of VJ Limited. So supposing there is a credit of 1 crore with the old registration. Now it is split into 3 registration. It is within VJ Limited. It is within distinct person. It is within VJ Limited, different registration. It is within VJ Limited but different registration, distinct person. So no need of transfer of liabilities, no need of CMA certificate. Now third difference, the way it works is different from demerger. First, condition is not there. Second, here if it wants, it can have the credit within itself, or it can give the credits. It can actually give the credits. How it can give? It can give the credit, it can have the credit with itself, or it can give to registration 2, or it can give to registration 3, or it can have between registration 1 and registration 2, or it can have share between registration 1 and registration 3, or it can share between registration 2 and registration 3, or it can be sharing between registration 1, registration 2 and, which is not possible in demerger. In demerger, there are conditions, transfer of liabilities and CA/CMA certificate. In demerger, it should be given to everyone. You don't have that option. Here, I may transfer or I may not transfer. If you see the last cases, there is transfer. Last all cases. In the first cases, I decided not even to transfer. I think no, I'll have it by myself. When I'm telling registration 1 with having it with itself, it is not transferring. It is not transferring. So there may be transfer, there may not be transfer. And when they are transferring, it may be transferred fully to registration 2 or fully to registration 3. Or shared between 1 and 3. Or shared between 1 and 2. Or shared between 2 and 3. Or shared between 1, 2 and 3. When it decides to share between multiple registration, then the ratio of value of assets will be relevant. Correct? Then, only then the ratio of, otherwise not relevant. If it decides fully give to registration 2, entire 1 crore to registration 2, there's no ratio. Give it full 1 crore to registration 2. If it decides to give full 1 crore to registration 3, give it full to registration 3. But if it decides to give between 1 and 2, or 2 and 3, or 1 and 3, or 1, 2 and 3, when it is deciding that, please go with ratio of value of assets. Actually, this is the best way to explain it. First, connect it with demerger. It is similar to demerger. How I did it? The presentation was given like demerger. Registration 1 is split into, right? Then tell the differences. It is different from demerger because it is actually not demerger. It is opting for multiple registration in the same state. There is no condition of transfer of liability, no condition of CA/CMA certificate. First difference. Second, when it is actually demerger, there is condition and you have to give to all the entities. You don't have an option. If a company is demerged into 3 entities, it has to give to all the 3 entities in ratio of value of assets. They don't have an option. They don't have an option to give only to the first new entity or second new entity. It has to give, but here there's an option. And what is the option? Either don't transfer, or if you transfer fully to 2, fully to 3, share between 1, 2, share between 1, 3, share between 2, 3, share between 1, 2, 3. So there are so many permutation combinations, correct? So many permutation combinations. First of all, there was an option not even to transfer. Or if I transfer fully to registration 2, no need of ratio. Fully to registration 3, no need of ratio. If I transfer to 1, 2, 1, 3, 2, 3 or 1, 2, 3, when I am transferring to multiple registrations, then I have to go with ratio of value of assets. Ratio of value of assets. The first 3 cases were discussed. This is actually the 4th case. The first 3 cases are discussed in Rule 41 and this is discussed in Rule 41A. This is actually very similar to demerger. Yes, there are differences which we have seen here. What are the main differences? Demerger, conditions, here no conditions. Multiple registration, no condition. Demerger, to be given to all in ratio. Here, I will decide to transfer or not to transfer. If I want to transfer, I have multiple options. And if I decide to give between 2 or more, then value of assets ratio will be relevant. That's everything about your special cases. Section 18. If I were to tell the gist of section 18, there are actually 4 special cases. 1, regular, composition to regular, exempt to taxable, new registration, availment. Second, composition, regular to composition, taxable supply becomes exempt supply, cancellation of registration, reversal. Third, sale of capital goods. Fourth, transfer of credit in case of sale, transfer, amalgamation, merger, demerger or multiple registration within the same state. Totally 4 scenarios of section 18. Look at all these 4 scenarios. One thing is common. It doesn't happen, in general mode of business, it happens very rarely. Once in a while situations. There are few situations which will happen once in a lifetime. Cancellation of registration will be once in a lifetime. Taking new registration will be once in a lifetime. So certain cases are once in a lifetime, other cases are once in a while. It doesn't happen frequently. So that is the reason the heading of section 18 is ITC in special circumstances. Because it doesn't happen routinely, it will happen once in a while. That's everything about your section 18. When you talk about your registration, let us first see your basics of registration. Start panning. Basics of registration. I said it for some purpose, but now come back here. Basics of registration. Registration is PAN based. Registration number is Aadhaar authentication based, Aadhaar linking based. Registration number is state based. You should have your registration based on your PAN. Without PAN, you cannot have GST number. Without PAN, you cannot have your, right? By the way, all these 3 concepts, PAN based, Aadhaar based and your state based all these 3 things are relevant for your GST number, GST identification number, which is nothing but a 15-digit number. First 2 state code, next 10 PAN, then entity number in that state. What is the entity number in that state? Not PAN India, entity number in the state. Then by default alphabet Z as of now. Then you have a random checksum digit. Random checksum digit. So first 2 state code, next 10 PAN, 13th number entity number in the state. If I am registered in Tamil Nadu and Maharashtra, 13th number in Tamil Nadu will be 1, 13th number in Maharashtra will also be. If I am getting more than one registration in the state, then it will change to 2, 3 and all. 14th is alphabet Z and 15th is random checksum digit generated by the system itself. Now, when I tell it is PAN based, everything is dependent on PAN, but there are exceptions. There are exceptions. Now, what do you mean by exceptions? Not based on PAN. What are the cases where it is not based on PAN? Your GST TDS number is not based on PAN. Second, when you're talking about NRTP, non-resident taxable person, it is based on GST TDS number is based on your income tax TAN. NRTP registration is based on PAN but of authorized signatory, not of the non-resident but of the authorized signatory. Third, your OIDRS and OMG from non-taxable territory, they may or may not have PAN, so it is not based on PAN. And fourth, unique identification number, UIN, international bodies, it is not based on PAN. So there are 4 exceptions. GST TDS number, not based on PAN, it is based on TAN, tax deduction account number. Second, NRTP, it is based on PAN but not of the non-resident but of authorized signatory, who should be an Indian resident and valid PAN card holder. Valid PAN card holder. Third, OIDRS, OMG, online information database, access and detail sources, online money gaming, outside India, not person in India, who are outside India, not based on PAN. Fourth, unique identification number. They don't have their GST number. They don't actually have GST number. They have UIN number. They don't have GST number. They have UIN number, which is not based on PAN. Which is not based on PAN. Now, your GST is generally linked to Aadhaar. When you're getting your GST number, it should be linked to your Aadhaar. But there are exceptions. What do you mean by exception? Aadhaar authentication is not required. Aadhaar authentication is not required. In which all cases Aadhaar authentication is not required? When you talk about Aadhaar authentication not being required, you don't require Aadhaar authentication for non-citizens. Non-citizens means that OIDRS, OMG outside India will get covered. Non-citizens. Second, you don't require Aadhaar authentication for UIN. You don't require Aadhaar authentication for UIN. Third, you don't require Aadhaar authentication for government, public sector undertakings and statutory bodies like ICI. Government, public sector undertakings, that is government undertakings and statutory body. So for these people, Aadhaar authentication is not at all required, exempted. Aadhaar authentication is not at all required, exempted. For others, Aadhaar authentication is required, but if you are ready for physical verification before grant of registration, if you are ready for physical verification, if you are ready for physical verification of your premises, business premises, physical verification of your business premises before registration is given to you, you forget about Aadhaar linking. You tell that I don't want to link my Aadhaar. I am ready for physical verification of my business premises. Before you grant me registration, come and verify my business premises. Come and verify my business premises. See, it is very different from PAN. It is actually very, 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 very different from PAN. So in PAN, you have 4 exceptions. In PAN, you have 4 exceptions. One is GST TDS, one is NRTP, one is OIDRS and OMG but outside India, and one is UIN. But in this case, for these people, PAN is not mandatory. TDS, it is based on TAN. NRTP, it is based on PAN of other person, authorized signatory. Otherwise, PAN is not required. Others, PAN is mandatory. PAN is, you don't have an exception. You don't have an exception. But here, there are certain categories where Aadhaar authentication is exempted. Who are they? Non-citizens, UIN, government, public sector undertakings, statutory body. It is exempted. For others, it is required. But you have an option. You can tell that I am not interested in Aadhaar authentication. I am ready for physical verification of my premises. Physical verification of my premises. I am ready for it. I am ready for it. And secondly, you have to understand your PAN is for, when you're talking about your PAN, it is for natural persons as well as artificial persons. Correct? Even company will have a PAN. But Aadhaar is only for natural persons. It cannot be for. Then when I am talking about Aadhaar linking, how it will work? How it will work? So when you are talking about what can be the categories? Individual, HUF, partnership firm, LLP, company. You can have AOP, BOI. You can have trust. If I am talking about individual, Aadhaar authentication is of whom? The same individual. The same individual. If I am talking about HUF, Aadhaar authentication is of Karta. If I am talking about partnership firm or LLP, Aadhaar authentication is of one of the partner. If I am talking about company, Aadhaar authentication is of director. Aadhaar authentication is of director. If I am talking about AOP, BOI, Aadhaar authentication is of members of managing committee. If I am talking about trust, board of trustees. So when I am talking about Aadhaar authentication here, it is of natural person. Plus, in all such cases, in addition to these persons, Aadhaar authentication will be also of authorized representative or your authorized signatory. Supposing a company is there, Aadhaar authentication is of one of the director, plus company appoints general manager as authorized signatory. Even authorized signatory, Aadhaar authentication should be linked. So is it required for individual? Yes. Supposing I am the individual running a proprietorship concern, Aadhaar authentication is of myself, plus I have assigned one of my employee as authorized signatory. So Aadhaar authentication will be of myself as well as authorized signatory. So what if director himself is authorized signatory? Then one is sufficient because both of you are the same. Clear? Clear? This is Aadhaar authentication. This is Aadhaar authentication. Aadhaar authentication. Are we clear with the differences between PAN and Aadhaar? PAN is forget about special person. Otherwise, PAN is mandatory. Aadhaar linking, special person exempted. Otherwise, Aadhaar authentication is not mandatory. You can still escape Aadhaar authentication. How? You can tell that I don't want to link my Aadhaar. You come for physical verification of my premises before grant of registration. Before grant of registration. So government cannot force Aadhaar authentication. Aadhaar authentication is nothing but Aadhaar linking. Government cannot force Aadhaar authentication. If you are not ready for it, don't worry. Aadhaar authentication will be removed and government will send departmental officer for physical verification of your business premises before grant of registration. Before grant of registration. Are you guys clear with this understanding? Are you guys clear with this understanding? So this is the difference. Now government is actually interested in Aadhaar linking. So they cannot force you. They know that you can escape Aadhaar linking by giving physical verification of premises. So they brought a rule, which is rule 10B. I'm again completing all the points of your Aadhaar linking. Now what is that rule basically talking about? That rule is telling that normally I cannot force you by linking your Aadhaar. But if you want RRR, if you want to go for revocation of cancellation, if you want to go for normal refund, If you want to go for special refund, normal refund under Rule 89, special refund under Rule 96, RRR. I cannot force you to link your Aadhaar at the time of taking registration, but because you could have said that I don't want to link my Aadhaar, come for physical verification. But if you want to apply for RRR, assessee is interested in application for revocation of cancellation, normal refund and special refund. So government tells that if you want to come for Aadhaar, RRR, Aadhaar authentication is mandatory. You cannot escape. But 99.99% assessees can survive without linking the Aadhaar. Who are the persons who will be mandatory linking their Aadhaar? Those who want to go for revocation of cancellation or refund under Rule 89, normal refund, or refund under Rule 96, automated special refund. You have to link your Aadhaar. You have to link your. For them it is mandatory. For them it is mandatory. But again, they give a relaxation here. If a person tells that he is not even having Aadhaar, then they tell that don't worry. You do something before RRR and something after RRR. What do you do before RRR? Before RRR, you give us the proof that you have applied for Aadhaar authentication. Enrollment ID slip. Enrollment ID slip for Aadhaar. That you don't have Aadhaar, but you have applied for. You don't have Aadhaar, but you have applied for. You give me proof. I agree that you don't have Aadhaar, but you give me the proof that you have applied for Aadhaar. Second, you give one photo proof. That one photo proof can be your bank passbook with your photo, or voter ID card, or your driving license, or your passport. You give us this. This you do before applying for RRR. After applying for RRR, you promise that within 30 days of getting the Aadhaar number, you will link your Aadhaar. You promise that within 30 days of getting the Aadhaar number, you link your Aadhaar. Now this relaxation will be there only for whom? Those people who tell that for me to link Aadhaar, I have to first have Aadhaar. They tell that don't worry. You come for RRR, revocation, normal refund, special refund. Before RRR, you give us two things. Prove that you have applied for Aadhaar card and one of the photocopy proof. And after applying for RRR, you promise that you will do something. Within 30 days of you getting Aadhaar. So when you have applied for Aadhaar, you will get Aadhaar. Within 30 days of you getting the Aadhaar, please link your Aadhaar. Because we want for RRR, Aadhaar linking mandatory. Now coming back here, for registration whether Aadhaar linking is mandatory? No. I can escape Aadhaar authentication or Aadhaar linking by opting for physical verification of premises before registration is granted to me. Now registration is state based. One state, one registration. One state, one registration. If I'm working in 10 states, 5 states, if I'm having branches in 15 states, 15 registration. But again, there are exceptions. There are exceptions. Exception 1. It is not one state, one registration. Pan India, one registration. Normal policy is one state, one registration. Correct? Now if I am telling Pan India, one registration. Pan India, one registration is for whom? OIDRS, OMG outside India, and UIN. These people always comes under exception. For them, PAN is not required. For them, Aadhaar linking is not required. For them, full India, one registration. Full India, one registration. Now, second exception. This is exception type 1. Exception 2. One state. Previous point, Pan India, one registration. Now, within one state, multiple registration. Within one state, multiple registration. Can I go within one state, multiple registration? Yes. if I'm having in one state domestic tariff area and special economic zone, I have to take multiple registration, which is mandatory. I don't have an option. In Tamil Nadu, I am working in 8 branches. 8 branches. 7 branches in domestic tariff area, which means normal India, other than SEZ. Normal India other than, and 1 branch in SEZ. How many registration I'll have in Tamil Nadu? I'll have 2. I don't have an option. I don't have an option. Or if I'm having additional places of business, I can go for multiple registration, which is optional. I'll take the same example. In Tamil Nadu, how many branches I'm having? How many branches I'm having? 8. What is the minimum registration that I have to take? 2. I have to take 2. 1 for 7 branches in DTA, 1 for SEZ. Can I take 3? Yes. Can I take 4? Yes. Can I take 5? Yes. Till 8. That is optional multiple registration. That is optional multiple registration. If I am having SEZ in a state, I have to take mandatory multiple registration. Otherwise, for each of the branches, I can take separate registration, but that is optional. So it can be 2, 3, 4, 5. I can mix anything. If I tell I'm working in Tamil Nadu and Maharashtra, 10 branches each, what will be a normal answer? Tamil Nadu and Maharashtra, 10 branches each. What will be the answer? I am working in Tamil Nadu and Maharashtra. What will be your answer? I have 10 branches. 10 places of business. Technically, places of business. So how many registration? 1 in Tamil Nadu, 1 in Maharashtra. But if I tell out of 10 places of business, 8 are in domestic tariff area, 2 are in special economic zone. 9 are in domestic tariff area, 2 are in special economic zone. Sorry, 1 is in special economic zone. So, what will be the number of registrations? In Tamil Nadu, no. For both the special economic zone I can have, and in Maharashtra. So what is the minimum registration that I have to take? 2 plus 2. What is the maximum registration that I can have? I can have up to 10 plus 10. Clear? I can decide. And ICA will try to confuse it that a few branches will dealing with textile sector, few branches with jewelry sector. Not relevant. Whether it's textile or jewelry, I can club all. I can have one registration for few branches of textile and few branches of jewelry. I can have another registration for balanced branches of textile and balanced branches of jewelry. That line of business is not important. Line of business is not important. So this is how you get multiple registration. So normally the concept is one state, one registration. Can there be pan India one registration? Yes. OIDRS outside India, OMG outside India, UAN. Can I have one state multiple registration? Yes. If it is SEZ, mandatory multiple registration. If it is normal branch, optional multiple registration. Optional multiple registration. So that is all about your basics of your registration. Basics of your registration. That state area was extremely important when you talk about your state-based. State-based. Talking about your registration, once you're very clear with the concept of PAN-based registration, Aadhaar-based registration and state-based registration, other things are quite simple. Now, you need to know that we have 3 things in your registration. One is application for registration. The other is your amendment of registration, and the last is cancellation. Your birth, life and death. Application of registration is the birth. Life is all about changes, amendment of registration. And the ultimate truth of life is Death, cancellation of registration. Application of registration can be by SSC or can be by department. You can apply on your own or department will give suo motu. When will SSC apply for registration? Two scenarios. SSC will apply for registration if he finds that he is liable for registration under section 22 or 24. Section 22 is turnover based registration, 24 is compulsory registration. He is liable for registration under section 22 or 24, or he is not liable for registration but he is ready to go for voluntary registration, section 25. He is not liable, he is not required to take registration, but he is going for voluntary registration. When department will give suo motu registration? Only in one scenario. SSC is liable for registration but is not applying for registration. So department will come and suo motu give registration. You are liable, your turnover is very big, or you are covered by compulsory registration, but you are not coming and taking registration. Fraud person. So department will give suo motu registration. Suo motu registration. 2 cases by SSC and 1 case by department. 1 case by suo motu by department. When you talk about amendment, amendment cannot be done by department. Amendment can be done only and only by SSC. Only you can amend yourself. Right? So it is again about life. Only you can change yourself. Right? It cannot be done by others. By SSC, core field amendment, non-core field amendment. Important changes in your life, non-important changes in your life. Changing the clothes is all not important changes in your life. Buying new clothes are all not important changes. Correct? What is the core field amendment? Changing your inner soul is core field amendment. It's just like birth, life and death. Amendment by department is not possible. Either only by SSC. Core field amendment, non-core field amendment. Examples of core field amendment. Changing the legal name of business. Legal name, PAN card name. Reliance Limited is changing the name to Ambani Limited. Legal name. Legal name. Trade name. Changing the trade name is non-core field amendment. Legal name. Trade name is the business name. You can have brand names. So that is non-core field amendment. What is the core field amendment? Legal name of the business. Next, you are talking about changing the address. Addition, deletion or change of address, or even changing the principal place of business. Doing something with your address. You are adding additional place of business or removing additional place of business, or you are changing the principal place of business. Doing anything with principal place of business or addition place of business. Either changing it or adding it or removing it. Right. Next is all about person. It's all about person. That is partners, directors, karta, CEO, authorized signatory. Either adding them or removing them. Adding them or removing them. Legal name, address, important persons. Partners, directors, CEO, CFO, authorized signatory. These all names will be there in your GST portal. If a partner is removed, core field amendment. Partner is added, core field amendment. Director is removed, core field amendment. Director is added, core field amendment. If authorized signatory is changed, your general manager changes. So earlier authorized signatory was your old general manager. Now you have appointed new general manager. So you want him to be the authorized signatory. Change in authorized signatory. Change in authorized signatory. Core field amendment. Core field amendment. So these are certain examples of core field amendment. Non-core field amendment. Change in brand name or trade name. Core field or non-core field? Non-core field. Change in mail number, mail ID and mobile number. Mail ID and mobile number. Non-core field. What is the difference between core field amendment and non-core field amendment? Core field amendment, officer will approve it. Non-core field amendment, there will be automatic approval. There will be automatic approval. Proper officer approval is not required. There will be automatic approval. No proper officer approval is there. Now, when you talk about cancellation, cancellation can be by SSC or by department. By SSC or by department. 4 cases which can be by SSC or by department. There are totally 10 cases which can be only by department. Suo motu by department. Suo motu by department. When you talk about cancellation, why will SSC go for cancellation, or in the first 4 cases, either assessee can do or even department can do. In the next 10 cases, only department can do. Why will assessee go for cancellation? Either yes, stopped his business, stopped, or yes, sold his business, transferred. Sale of business includes death of a proprietor, where legal heir continues the business, because PAN of legal heir will be different from the PAN of the deceased person. Correct? That is also sale of business. That is also sale of business. Stopping of business, discontinuation, selling of business, transfer, or change in constitution of business with change of PAN. I'll give you an example to make you understand it. There is a partnership from ABC and Co. ABC and Co. Now new partners are coming, DEF, and they want to change the name to DEF and Co. They are just changing the name in the PAN card. What you will do? ABC and Co becomes DEF and Co. ABC and Co becomes DEF and Co. They are changing the legal name in the PAN card. What will you do? Louder. Louder. Core field amendment. They'll do 2 core field amendments. First, change the legal name. Second, add the new partners and remove the old partners. There is no new registration, no cancellation. Why? GST is based on PAN. If PAN is same, no need of new GST number. But if I change this example and I tell that ABC and Co becomes DEF and Co, DEF and Co applies for new PAN. DEF and Co applies for, it is a new firm with a new PAN. In the old example, the PAN card was the same, but the name is changing and the partners are changing. In this example, DEF and Co tells that no, we'll not go with the same PAN, we'll apply for the new PAN. Then what will do? ABC and Co has to apply for cancellation. DEF and Co has to apply for new registration. Why? GST number is based on PAN. If PAN changes, old firm apply for cancellation, new firm apply for new registration. Apply for new registration. Here we are talking about change in constitution with change of PAN. When PAN changes, what old firm has to do? Apply for cancellation. New firm will apply for new registration. New entity will apply for new registration. And the last scenario. For understanding the last scenario, you should have a clear-cut understanding of why assessee took registration. Why assessee took registration? Assessee took registration because he was liable. Now he is no longer liable. Or assessee took voluntary registration. Now he is not interested in voluntary registration. Assessee took registration because he was liable. Now he is no longer liable for registration under section 22 or 24. Exactly, Uta. If you are liable for registration 22, 24, apply for registration. If you are no longer liable, cancellation. Or why assessee took registration? Why assessee took registration in the second case? Voluntary registration. Now he took voluntary registration, but he found that the moment you take registration, payment is must. He was having a different understanding that even after taking voluntary registration, he need not pay tax till 40 lakhs, 20 lakhs, 10 lakhs. He was not having a clear understanding of GST law. Then he realized that voluntary registration is not good for him. What he can do? He can apply for cancellation. He took voluntary registration by mistake without understanding the consequences. Now he is not interested in voluntary registration. Can he go out? Yes. He was never liable. He took registration. He is still not liable. He is cancelling his registration. He was never liable. He took registration. He is still not liable. He can apply for cancellation. These are the 4 cases where either assessee or department can go for cancellation. Now you are talking about 10 cases where department will initiate suo motu cancellation. Now when department is initiating suo motu cancellation, assessee is doing something wrong. Correct. What is that something wrong? Assessee is doing business from secret place. He is not conducting business from declared place of business, which means he is doing business from secret place. Or assessee is a pakka fraud person. He is giving fake invoices. He is giving no supply, but invoice is given, bill trading. Without even supplying, there is invoices being issued. You are cheating with the government, fake invoicing. You will not be paying output tax. Opposite person will take the credit. You will run away in 2-3 months. Bill trading, fake invoices. You are issuing invoice without supply. Issuing invoice without supply. Or, as this is a pakka fraud person, he has obtained registration itself by way of fraudulent documents or willful misstatement or suppression of acts. Registration itself was obtained by way of fraud, willful misstatement or suppression of acts. When it is found, it will be cancelled. When it is found, it will be cancelled. Or he violates Rule 10A. He violates Rule 10A. What is Rule 10A? You have to update your bank account within time. What is the time limit for updating your bank account? Once you get the registration, you update your bank account within 30 days from date of grant of registration or due date of filing your GSTR 1 or IFF, whichever is. There will be a time from the date of grant of registration, calculate 30 days. Supposing you have got registration on 15th September. 15th September, add 30 days. Balance 15 days of September and 15th October. And due date of GSTR 1 IFF. Supposing registration is granted on 15th September. What is 30 days from 15th September? 15th October. What is the due date of GSTR 1 and IFF for September? 11th October if it is GSTR 1. 13th October, not IFF. It will be quarterly GSTR 1. 13th October. Correct. 11th or 13th October. Whichever is earlier. Within that time, update your. Whichever is earlier. Which is earlier? Which is earlier? 11th or 13th of October. Whichever is earlier. Within that time, update your bank account details. If not, your registration will be cancelled. Your registration will be cancelled. Next, you're violating section 171, anti-profiting clause. When GST, this is not significant today, but it was significant when GST was born. When GST was born, people were getting more credit. More credit, less cost or more cost? If you get more credit, the cost will reduce. Your selling price should. But if you're not reducing your selling price, what will happen? More profit. When you get more credit, your cost decreases. Ideally, your selling price should. But if you're keeping the same selling price, cost decreases, but selling price is the same. You'll get more profit. Anti-profiting clause. This is not relevant today. You'll not spend much time. Anti-profiting. You're getting extra profit. You're not passing on the benefit to the end consumers. So GST will not, the benefit of GST will not be reaching to the end consumers. Anti-profiting clause. Anti-profiteering. So today's scenario, after a lot of years of GST, it's actually very irrelevant. Anti-profiting clause. Or you're violating Rule 86B. Rule 86B tells that if your monthly turnover is more than 50 lakhs, monthly turnover is more than 50 lakhs, more than, it is not applicable for all the months. In a particular month, if your turnover is more than 50 lakhs, in that turnover, you will not count exempt supply turnover, you will not count zero rate supply turnover, because on them you don't have tax. You will count only taxable supply. You will count only taxable supply. Then they tell that minimum 1% pay by cash. How? Supposing your output tax is 100 and input tax rate is 120. Normally, how much you'll pay by cash? Normally, how much you'll pay by cash? Your net output tax which will be paid by cash will be 0. What is the ITC carry forward? ITC carry forward 20. This is a scenario when Rule 86B is not applicable. If Rule 86B is applicable, when it is applicable? When your taxable supply monthly turnover is more than taxable supply. Don't count exempt supply, don't count zero rated supply. If the same question is given, what you will do? You had ITC of 120 rupees, but how much you will use? Only 100. Now your gross output tax is 100. You have ITC of 120. ITC of 120. They tell that minimum 1% of output tax you have to pay by cash. So minimum how much you have to pay by cash? You have to mandatorily pay by cash. You have to mandatorily pay by cash. Not 10, 1. What is 1%? What is 1% of your gross output tax? 1 rupee. If output tax is 100, 1 rupee. If output tax is 1000, 10 rupees. If output tax is 1 lakh, how much you have to pay? 1000. 1% of output tax you have to pay by cash. Now, how much credit you will use? So it is reverse. First, you find how much you have to pay by cash, then you will find 99. What is the ITC carry forward? Now, the ITC carry forward will be 120 was there, you have used 99. So, how much will be the ITC carry forward? Earlier, you had credit of 120, you used 100. What was the carry forward? So, it is not, you are not incurring any cost. You are paying more by cash, your credit carry forward will be more. Your credit carry forward will be, that is rule 86B for you. That is rule 86B for you. Minimum 1% of gross output tax has to be paid by cash. But when you are calculating it, whether 86B is applicable for all? No. It is applicable only for those people whose monthly turnover of taxable supply, other than exempt supply and zero supply, is more than 1 month 30 lakhs, not applicable. Other month 60 lakhs applicable. So it is monthly applicability. Monthly applicability. Yes, government has removed itself. There are exclusion list. So in 86B, you will find certain people being excluded. For government, it is not applicable. For public sector undertakings, it is not applicable. For statutory bodies, it is not applicable. For assessees who are taking refund of input tax credit more than 1 lakh, more than 1 lakh in the last year, it is not applicable. For assessees who are paying income tax, for assessees who are paying income tax more than 1 lakh, more than 1 lakh in last 2 financial years for which due date is over. I am giving the list for whom 86B is not applicable. Whom all? Government, public sector undertaking, statutory body. Government, public sector undertaking, statutory body. Then whom? You are talking about assessee who has claimed refund of GST input tax credit more than 1 lakh in last financial year, or assessee has paid income tax, who has paid income tax more than 1 lakh in last 2 financial year for which due date is over. For which, now if you are assuming that you are standing in May 2024, your last 2 financial year will not be 22-23 and 22-23-24. Why? For 23-24, due date of ITR is not yet over. It will be when you are standing in, supposing May 2024, last 2 financial years for which due date of ITR is over is 21-22 and 22-23, because 23-23 due date, 23-24 due date is not yet over. Right? For these people, 86B is not applicable. For others, it is applicable. For others, it is applicable. Are you guys clear with this understanding? Rather, I have given the entire gist of your rule 86B. Rule 86B. Now, if you are not complying with it, then officer will go for suo motu cancellation. Or you are taking more credit. You are taking wrong credit. You are taking credit which is not allowed as per section 16. Wrong credit. Cancellation. Or you are paying less output tax. More credit, less output tax. How you are paying less output tax? Your outward supplies in GSTR 1 is more than GSTR 3B. Your outward supply in GSTR 1 is more than GSTR 3B. You are claiming more credit, problem for government. You are paying less output tax, problem for government. Suo motu cancellation. Or you are a non-filer of return. You are a non-filer of return. So you are not filing the return for how much time? Wait. First, let us understand this very clearly. First, you are talking about regular scheme dealers. First, you are talking about regular scheme. Then you are talking about composition scheme. When I tell regular scheme will not only include regular taxable person, it will include casual taxable person, NRTP, everyone. Correct? So regular scheme, what is the time? Either you're not filing your return for 6 months or 2 quarters. If at all you're under normal scheme, 6 months. If you're under QRMP scheme, 2 quarters. You're not filing your return for 6 months or 2 quarters. For composition scheme, you're not filing your return, only one return, even after 3 months of the due date. So understand that for regular scheme, they are talking about 6 returns or 2 returns. 6 monthly returns or 2 quarterly return. For composition scheme dealer, they are talking only about one return, one yearly return, which you have not filed even after 3 months of due date. Difference is clear. So, regular scheme, you are not filing your 6 monthly returns or 2 quarterly returns. Composition scheme, you are not filing your 1 yearly return even after 3 months of due date. What is the due date for composition scheme dealer? After the year is over, 30 days, 30th April of next financial year. So 3 months are over. May is over, June is over, July is over. Even after July, you are not filing your GSTR 4. Then you are covered here. So non-filing of return. And finally, you're talking about a person who's very much optimistic. We'll do it. We will do it. Very much optimistic. First of all, that person applied for voluntary registration. Now look at this poor fellow. He applied for voluntary registration, but he's pakka return filer. Properly he's filing return. The moment next month comes, he's filing returns. But all his first 6 returns are all nil returns. He has not commenced his business in the first 6 returns. Think of the officer who's checking his returns. Every time he's filing the return, nil return. Officer will tell, why the hell you're taking registration? When you start your business, come. When you start your business, see, in all the other first 9 cases, you're actually doing something wrong. If you see all the 9 cases, if you count it, you'll find 9 cases. You're actually doing something wrong. Here, you're not doing something wrong. You're irritating the officer. You have taken voluntary registration, but you're filing the returns also. But you have not commenced the business even after taking registration for the first 6 months, which means your first 6 returns are all nil returns. They are all nil returns. Officer tells, please cancel the registration. When you actually start your business, come again, apply for registration, I will give you. Again, apply for the registration, I will give you. But there's a difference. Here, if you see the previous point, non-filing of returns, here you're talking about any 6 months or any 2 quarters. Here, the focus is only on first 6 months. See, supposing I take registration voluntary, I do some business. Then in between there are 6 nil returns, no issues. I take registration and my first 6 months return itself is, so that's the problem. The previous point is any random 6 months or 2 quarters. I took registration 3 years back. I was filing the returns properly. Now suddenly I'm not filing the returns. Any 6 months or any 2 quarters. But here it's focusing only on the first 6 months. I took voluntary registration. I'm not doing any business for the first 6 months. Are you guys clear with this understanding? So totally how many cases are there for cancellation? 4 cases which can be started by SSC or by department, and 10 cases which can be started only by department. Are you guys clear with this understanding? Right. So yes. Correct. So if at all you're liable. Then in a month you're not liable, your liable is not there. Say for example, I have a service under RCM. Right. The moment I have a service under RCM, at that point of time I'm liable for registration. I have to apply for registration. Next month I may not have RCM. That's not the criteria. The first time I am hit by liable for registration, I have to take registration. In the next entire 9 months, 10 months, 1 year, 2 years, I may not have any case of RCM. That's not at all relevant. Was I liable? Yes. So subsequently what is happening is not relevant. Right? So liability is not ascertained every point of time. It is ascertained once it is liable, then please take registration. Thereafter, what is happening? We are not going to take care of it. If you have interstate supply of goods only once, no problem. You are liable, compulsory registration. Take registration. Thereafter, you may never have interstate supply of goods. Nothing to do with it. You are liable at that point of time. Subsequent events are not relevant. Yes. You can do, assuming that once you are liable, you have taken registration and you see other things are not hitting. Again, you are not covered by 22 and 24. But please tell me a thing. Who will go apply for registration, then cancel it, then again apply for registration, cancel it? Bring that person in front of me. I want to see him. No one will do it. So your question is basically a point where once I am going to have that, I'll do it. So you have to evaluate. Very clearly evaluate that this will never happen again. Then I'll buy your point that you will apply for cancellation. But it is going to happen again once in a while. There's no person who will again apply, then cancel. Apply, then cancel. Yes, theoretically you can do. Theoretically you can do. But understand the fact that cancellation will take its own sweet time. Department is like a sweet darling. It will not react immediately. So don't expect department to react immediately. It will take its own sweet time. 2 months, 6 months, 1 year, 2 years. And at that point of time, again you'll have that transaction attracting registration. So that will be difficulties. That will actually not be that. But yes, I'll buy your point only to the extent only once in a while it came, and you're very clear that it will never ever came, and you're very clear that you will never ever be liable for registration, at least till foreseeable future. Not permanently, at least till your foreseeable future. Only then you'll apply for cancellation. Otherwise, you'll not apply for cancellation. Right. Now, once you know when registration is there, when amendment is there, once cancellation is there, life is very simple about the time limits and effective dates. When assessee applies for registration, it is a test match. It is a test match. Assessee has to apply within 30 days. This 30 days is very important. Assessee has to apply within 30 days from the date he is liable. If he is going for voluntary registration, not 30 days. He will apply whenever he wants. But when he is liable, he has to apply within 30 days. 30 days from the date he is liable for registration. Logical timing will be that. From date will be always logical. Once assessee applies, the ball will go to officer's court. Now, officer has got time of 7 working days or 30 days, depending on the situation. If at all there is no physical verification, 7 working days. If at all there is mandatory physical verification, in case you don't go for Aadhaar authentication, or you go for Aadhaar authentication but it fails, or you go for Aadhaar authentication, it is successful but you are a risky category assessee. 3 scenarios. You don't go for Aadhaar authentication, you go for it but it fails, it is not matching some technical issues because your name is different in different place, Aadhaar and PAN, or you go for it, it is successful but you are a risky category assessee. Risky category. So then there will be physical verification. If there is physical verification, then they'll have 30 days time. They'll require more time. They'll do physical verification, then they will give the registration. Now, officers is having this time not to give registration alone, either to give registration or to give notice. This is the first innings of officer, either to grant or to give show cause notice. Either to grant, if he is satisfied, give it registration. If not satisfied, give notice. If the notice comes, if the love letter comes, only then the second inning starts. If notice does not comes, the game is over. If notice comes, second inning starts. Then assessee has to reply to that notice within 7 working days. And then the ball will go to the officer, and officer will take action within 7 working days of reply. What action now he will take? Now he will either grant it or reject it. If satisfied, grant it. If not, reject it. In first innings, grant or notice. In second innings, grant or reject. What is the time limit of first innings for assessee? For assessee, it is 30. For officer, it is 7 or 30. Second innings, assessee 7, officer 7. Clear? Clear? And if officer is not able to do the work within his time, first innings time or second innings time, if officer is not able to do his work within the time, registration is deemed to be granted. In first innings, officer either should take action within time of 7 or 30 days, either grant or notice, otherwise deemed to be granted. In second innings, within 7 working days, either grant or reject, or if no action, deemed to be granted. Deemed to be granted. So officer is required to do his work on time. Right. This is when assessee applies for registration. When assessee applies for, what if department gives suo motu registration? When department gives suo motu registration, first of all, you get a temporary registration. Without an opportunity, assessee will get a temporary registration. Assessee will get a temporary registration. Then assessee will have 90 days time either to go and convert temporary registration into permanent registration or to file an appeals. Now again, here assessee has got 90 days time. First innings is over. Department, no time. Department will give temporary registration. Now assessee, you decide. Within 90 days, either convert TR to PR, temporary registration to permanent registration, or go for appeals. If you convert temporary registration to permanent registration, the match closes there. If you go for appeals, now there are multiple possibilities. If appeal is in favor of officer, that officer, you did right, registration was to be given, then assessee has to convert temporary registration to permanent registration within 30 days of appeals order. Within 30 days of first innings, 90 days. Second innings, 30 days. 90, 30. And both these time limits are only for assessee. 90 and 30. If proper officer loses the case, if assessee wins the case, what will happen? Think logically. Temporary registration will be cancelled. Here also 2 innings, but both innings time limit is only for assessee. What is the first innings? Officer will give temporary registration. Assessee, what you have to do? 90 days. Be satisfied, convert temporary registration into permanent registration. If not satisfied, go for appeals. If you have taken permanent registration, match closes there. If not, second innings, appeals. Appeals is in favor of assessee. No issues. Temporary registration is cancelled, but appeal is in favor of officer. Then assessee, second innings, 30 days of appeals order. Convert temporary registration into permanent registration. Submit all the required documents. Right. Now, you're talking about amendment. Assessee going for core field amendment. Core field, just remember, assessee going for registration, core field amendment is automatic. What was the time limit, by the way, for registration? 30, 730, 7, 7. Correct. Here it is 15, 15, 7, 7. Over. 15, 15, 7, 7. Assessee has to apply for amendment within 15 days of change. First innings. This is actually the first innings. Then the second innings. Then officer, what he has to do? Either accept the amendment or give notice within 15 working days. If officer is not taking any action, deemed to be amended. Same. Then, if it is amended, the match closes there. If notice is given, assessee has to reply within 7 working days. Second inning starts. After reply, officer has to take action within 7 working days. What action? Either amend, accept or reject. If no action is taken, deemed to be amended. It is exactly same as registration. The time limit were 30, 730, 77. Here it is 15, 15, 77. 15, 15, 77. Sir, what about assessee going for non-core field amendment? It is automatically approved. No need to discuss. It is automatically approved. Proper officer will not come here. Automatically approved. No role of proper officer. Automatic approval. Now, finally, we are talking about cancellation. Assessee applying for cancellation. Assessee applying for cancellation. Department initiating cancellation. Now, please understand, unlike registration and amendment, cancellation is one-day match. Cancellation is not test match, it is a one-day match. If assessee is applying for cancellation, assessee has to apply for cancellation within 30 days of event warranting cancellation. Means what triggered cancellation? If at all I am selling my business, within 30 days of sale of business. If I am stopping my business, within 30 days of stopping my business. 30 days. And thereafter, officer will take action within 30 days. And if department is initiating cancellation, department first will give show cause notice to the assessee. Then assessee will have 7 days time to reply to the notice. And after reply, officer will have 30 days time to decide whether to do cancellation or not to do cancellation. So if you look at things carefully, one-day match. If assessee starts 30-30, assessee has to apply within 30 days, officer will have 30 days time. If department starts, department will give love letter notice. Then assessee will have 7 working days time and department will have 30 days. 30-30, 7-30. 30-30, 7-30. 30-30, 7-30. One-day match, one-day match. They are not same thing, they are separate thing. One is assessee starting cancellation, other is department starting cancellation. But a very, very, very important point. 2 evident differences that you'll find about cancellation which is not there in registration and amendment. First, it is a one-day match. Second, if officer is not able to do the work within his time, there's no concept of deemed to be cancelled. No concept. Which means this time limit for officer in both the cases, where both the cases it is 30 days for officer. Technically, he will not take 30 days. He'll take more than 30 days. And even if he's taking more than 30 days, nothing will happen. And that is the reason when she asked the question, I said that officer will take its sweet time. He may take 2 months, 6 months, 1 year. I think now you can connect the dots. This is a recommendatory time limit for the officer. Unlike registration and amendment, this is not a mandatory time limit. Officer will take its own sweet time. Though it is 30 days given, but he will take more than that. And he can take it because cancellation is an important event. Clear? He will take its own sweet time. So there's no concept of deemed to be cancelled. Unlike deemed to be registered, deemed to be amended, there's no concept of deemed to be cancelled. Deemed to be cancelled. Now, this entire registration thing, we are taking it spiritually. Birth, life, death. So there should be rebirth. There should be rebirth. In fact, that is rebirth in registration chapter. That is rebirth. Revocation of cancellation. Revocation of. But please understand that rebirth is there only in murder case. Only in murder case. It is not there in suicide case. If assessee himself has applied for cancellation, no rebirth. You are not a hero. Suicide. No question of rebirth. You have been murdered by villain department. Like your movies, Collywood, Tollywood or Bollywood movies. Once a hero is out, be it Shivaji or any other movie, we know that he will come back. We know that he will come back. So that's a concept of rebirth. That's a concept of rebirth. But when? Suicide case or murder case? Murder case. Be very clear. It is not in suicide case, it is only in murder case. So that's revocation of cancellation. Now revocation of cancellation is test match. Is test match. Who will start revocation, by the way? Assessee. He has died, he will start rebirth. So assessee will apply for revocation within 90 days plus 180 days extension. Time limits are changed. 90 days plus 180 days extension by the commissioner. And after he applies, proper officer will have time of 30 days. Either accept or give notice. If he is accepting, match is over there. If he is giving show cause notice, second inning starts. Assessee will have 7 days time to reply to the notice. And finally, officer will have 30 days time to accept or reject. See, throughout cancellation, officer is having 30 days time. Throughout cancellation. Officers having 30 days time. So here this test match goes this way. 90 plus 180 SSC. Officer 30. SSC 7. And officer again 30. 90, 30, 730. 90 plus 180 obviously extension. 90, 30, 730. When I tell accept revocation will be accepted, which means you will become alive again. If revocation is rejected, you're already dead. Nothing will happen. Rebirth will not be there. If revocation is rejected finally, nothing will happen. You're already dead. Only if revocation is accepted finally, there will be rebirth. There will be your GSC number which was dead again will become alive. Again will become alive. Are we guys clear with this entire understanding? Are you guys clear with this entire understanding? So 90, 30, 7, 30, but 90 is 90 days plus extension 180 days. Now we are talking about very important area of your registration, which is effective date of registration, effective date of amendment, and effective date of cancellation. Now make it very clear. First we'll see the simplest part. Effective date of cancellation. Cancellation is fully under the control of whom? Officer. Effective date of cancellation, be it assessee applying it or department starting it, effective date of cancellation is always determined by the proper officer. It's always determined by the proper officer in both the cases. And your cancellation can be effective from today's date if today cancellation order is given, or it can be effective from a retrospective date. Cancellation order may be given today, but it may be applicable from a old date, retrospective date. Who will decide it? Officer. You don't have any control. He will give you cancellation order effective from today or from old date. Prospective effect or retrospective effect. In both the cases, whether you apply or whether he initiates. In both the cases. Now, what is the effective date of registration? A very important area. Effective date of registration. Now, please understand your effective date of registration in this way. Now, when you talk about effective date of registration, if assessee is applying for registration, assessee is applying for registration and he is liable for registration and he is applying within 30 days. In all other cases, if department is giving suo motu registration or assessee is applying for registration but it is voluntary registration, or assessee is applying for registration but he is not applying within 30 days. He is not applying within 30 days. In all these cases, your effective date of registration is date of grant of registration. Not when you applied, but when you got it. You are liable in April. You applied in May, maybe say after 30 days. You got in 15th of July. Your effective date of registration is 15th July. Not April, not May. 15th date of grant of registration. This is very important because if your effective date of registration is 15th July, you can take credit only from 15th July. You can take credit only from 15th July. When it is old date, only in one scenario. Effective date of registration is date when you are liable for registration. When is that? You are applying for registration. You are liable plus you are applying within 30 days. It is date when you are liable for registration. Date when you are, if you are liable for registration on 10th April, you applied on 30th April, you get the registration on 15th July. Same thing, 15th July you get. In both the cases you get on 15th July. Though you get your registration certificate, grant of registration is 15th July, it will be effective from 10th April, which means you can take ITC right from 10th April. Clear? I'll repeat for examples. You are liable in both the cases on 10th April. In one case, you applied on 30th April. In other case, you applied on 30th May. In both the cases, you got registration on 15th July. Let us take the first case. When you are liable, 10th April. When you applied, 30th April. Did you apply within 30 days? Yes. You got on 15 July. But what is your effective date of registration? Your effective date of registration is date when you are liable. When you are liable? 10th April. So from 10th April onwards, you will get input tax credit. By the way, when you got your registration certificate? 15 July. What will be your first return? July return. Your first return will be July return will include April, May, June, July transactions together. Output tax will be for 4 months and input tax credit will also be for 4 months, right, starting from 10th April. If I change the scenario, I tell you are liable for registration on 10th April, you applied on 30th May. Did you apply within 30 days? No. Did you apply within 30 days? No. You got the registration on 15th July. What is your effective date of registration? 15th July, date of grant of registration. Date of grant of registration. You will get input tax credit only from 15th July. What will be your first return? Same July return, which will include transaction of April, May, June, July. But now that's different. Output tax will be from April, May, June, July. But your ITC will be only from 15th July, not full July. 15th July. Clear? So that is the importance of your effective date of registration. Effective date of registration. Done. So effective date of cancellation over, effective date of registration over. Effective date of amendment. If it is non-core field amendment, it's by default over. It is the date when automatic approval happens. Automatic approval happens. If it is core field amendment, so when you talk about your effective date of core field amendment, so we are not talking about non-core field amendment, we are talking about core field amendment. What is the time for you to apply? Whether you apply within 15 days or you don't apply within 15 days, it really doesn't make any difference. Your effective date of amendment is date of submission of application for amendment. Effective date of amendment is date of submission of application for amendment. Your amendment is happening on 10th April. Whether you apply within 15 days, 20th April, or you apply after 15 days, 30th May, no difference. When you applied, in the first case, you applied on 20th April. So your amendment is effective from 20th April. In the second case, you applied on 30th May. So your amendment is applicable from 30th May. In both the cases, it is approved on 15th of July. Not relevant. See, amendment is very special. In registration, either it is a future date grant or it is a old date liable. But in amendment, it is not the old date when change has to be done. It is not the future date when it is approved. It is date when you submit. Date when you submit the application. Date when you submit the application. But wait. This effective date of amendment in both the cases can be date when actually change happened, which means old date, which means 10th April in our example. In both the cases, whether I applied within 15 days or I applied after 15 days, but this is possible only with the approval of commissioner. Normally, my effective date of amendment is when I apply. It is not when change happened. It is not when it is approved. When I applied. When I applied. Present date. Neither the future date nor the old date. It is the present date. It is the present date. It is neither the old date nor the future date. In registration, it is either the old date or the future date. What is the old date? Date when you are liable. What is the future date? Date when it is granted. But here it is the present date. Date when I applied. Date when I submitted my application for amendment. But can I make it as old date in both the cases? Yes. Whether I apply within 15 days or apply after 15 days, I can make it as date when change happened. Date when, which means when change happened on 10th of April, I applied on 20th of April or I applied on 30th of May. Within 15 days or after 15 days, I can make it effective from 10th April, but that is possible only with the permission of commissioner. That is possible only with the permission of commissioner. See, there is an evident difference between effective date of registration and amendment. First, in registration, it is either the old date or the future date. Second, in registration, no one can change the effective date. No one can change the effective date. Here, in amendment, what is the effective date of amendment? When you actually applied, present date. Neither the past date, date when change happened, nor the future date, date when it is going to be approved. It is the present date. Second change. Can I make a change in answer? Yes. My effective date can be the date when change happened. Date when amendment actually happened. When the change happened. I can make it old date. But through commissioner. That is the effective date of amendment. In all these three scenarios, what is the most important effective date which is repeatedly being tested? Effective date of registration. Effective date of registration. Very important, very crucial for different places. This 30 days is important not only for your registration chapter that you have to apply within 30 days when you're liable. Assessee, once he's liable, he has to apply within. When I have wrote 30 days, what is the meaning of this 30 days? What is the meaning of this 30 days? After he is liable, he has applied for registration within, or he has not applied for registration within. 30 days is crucial for registration chapter. It will be helpful in written filing chapter, which we have discussed. It is helpful in ITC chapter that already we have discussed. ITC, whether eligible or not. And it is not only the date of ITC. If you apply within 30 days, you can get the ITC on even stock. Not only the new purchases, even on the stock. If you don't apply, you will get ITC only from 15 July in our example, and forget about ITC on stock. And it is even relevant for revised tax invoice. 4 chapters is 30 days comes. Which all chapters? It is there connected to your registration chapter. Main starting point is registration. Connected to your ITC chapter. Main linkage is ITC. Connected to your written filing chapter when you are talking about first return. Connected to your document chapter when you are talking about revised tax invoice. Revised. You can give revised tax invoice only if you have applied for registration within. Otherwise, you cannot even give revised tax invoice. You cannot even give revised tax invoice. Very, very crucial point. This 30 days is there. So this completes your understanding of application, registration, amendment and cancellation. Life, birth, life and death. And not only that, we have also spoken about rebirth. Rebirth is there only at the time of murder case, not suicide case. It is there only at the time of murder case when department cancels your registration, not when you yourself cancel your registration. Yes, when you talk about persons who are liable for registration, you have to see 3 provisions altogether. Section 22, turnover based registration. 24, compulsory registration, read along with section 23, no registration. Now, before we see section 23 and 24, the first provision should be section 22, turnover based registration. Turnover based registration. Based on your turnover, you have to get registered. But which is more powerful? Compared to 22, 24 is more powerful. Compared to 24, 23 is more powerful. 22 is turnover based registration. Then your more powerful provision, section 24 compulsory. And the most powerful is section 23, which tells that no need of taking registration. Now, what is this turnover based registration? Remember the story where we have discussed about politics? Right. So, we are talking about Apni politics can be summarized in 3 things in India. One is money, next is land and Ram. And when you are a very small person, turnover based registration means when you are a very small person, this entire exercise should be time pass for you. Politics should be time pass for you. Now, what is the full form of AP? Arunachal Pradesh. S, U, so S, Sikkim, U, Uttarakhand, M, Meghalaya, Tripura, Manipur, Nagaland, Mizoram, and Telangana, Puducherry. Obviously, you'll have your other states and union territory not being covered here. So, when you talk about your Apni politics summary, and when you talk about Telangana and Puducherry, situation is different. We have to bifurcate now into 3. When you talk about Tripura, Manipur, Nagaland and Mizoram, you need to understand that for them, the limit is always 10 lakhs. Be it supply of goods or be it supply of service or be it supply of goods plus supply of service. The limit is always 10 lakhs. Whether you are dealing only with goods or services or goods plus services, limit is always 10 lakhs. Now, when you talk about Arunachal Pradesh, Sikkim, Uttarakhand, Meghalaya, Telangana and Puducherry, whether you are talking about these will come together, whether you are talking about supply of goods or supply of service or supply of goods and service, supply of goods and supply of service, the limit is always 20 lakhs. The limit is always 20 lakhs. Other states, if at all you are talking about supply of goods alone, then it is 40 lakhs. Supply of service, supply of goods plus service. So if it is supply of goods alone, only then you have this 40 lakhs. If it is supply of goods plus supply of service or only supply of service, the limit is 20 lakhs. The limit is 20 lakhs. But this 40 lakhs, which is applicable for other states other than the special states, and that too applicable only when there is supply of goods, has two special points to address. What are the two special points to address? What are the two special points that you need to address them 40 lakhs separately? One is the plus sign and one is a minus sign. Plus sign is normally it is applicable only for supplier of goods. But even if you are talking about supply of goods along with interest on loans or deposits, you will still take the benefit of 40 lakhs. Normally, the moment small service comes in, you forget about 40 lakhs. You go to 20 lakhs and lakhs. But they allow one particular service to be along with supply of goods. Still, you can get the benefit of 40 lakhs. Interest on loan is not excluded. It is included. But still, in aggregate turnover, you have to add interest on loan. Unlike composition scheme, you have to include it. But you can still enjoy the benefit of 40 lakhs. Supposing supply of goods is 30 lakhs. Interest on loan is 5 lakhs. So your aggregate turnover is 35 lakhs. Normally, if it is goods plus services, you will resort to 20 lakhs, which would have said that you have to take registration. But in this case, you are not required to take registration. Why? Your limit is now 40 lakhs. If at all assuming you are there in states other than the special states. Your aggregate turnover is 30 lakhs goods and 5 lakhs services being specifically interest on loans or deposits. This relaxation is not for any other service. It's only for interest on loans and deposits. If it is along with goods, if it is only service along with goods, then still you can enjoy 40 lakhs, need not go down to 20 lakhs. One minus, which means you cannot enjoy the benefit of 40 lakhs in certain cases. When? We have already covered this. When your supplier, be it a trader or be it a manufacturer of what? Pan masala, tobacco, ice cream, and building materials. Aerated water will not come. Pan masala, tobacco, ice cream, and building materials. If you are dealing with any of these items, pan masala, tobacco, ice cream, and building materials, you will resort to 20 lakhs. You cannot go for the benefit of 40 lakhs. You cannot go for the benefit of 40 lakhs. So that is all about turnover based registration. Please remember that aggregate turnover includes exempt supply. Exempt supply includes non-taxable supply. When you are getting a question where you are working in multiple states, aggregate turnover is pan-India turnover. Aggregate turnover is, which means if I am working in 2 states, first I will check my aggregate turnover. I will check my, not individually, I will check my aggregate turnover in totality. Both the states turnover, I will add the number and I will see whether I am crossing this 40 lakhs, 20 lakhs, 10 lakhs, or I am within this 40 lakhs, 20 lakhs, 10 lakhs. If I am crossing this 40 lakhs, 20 lakhs, 10 lakhs, I have to get registered in both the states. Checking the criteria of aggregate turnover is pan-India. It's not state-wise, it is pan-India. I will sum up the total of all the states and see whether the aggregate turnover is up to 40 lakhs, 20 lakhs, 10 lakhs. If it is below it, no need of registration in any of the states. If it is above it, I have to get registered separately in each of the state. Now that is not mandate here. Separately in step 1, aggregate tenure, not for each state, all the states put together. Step 2, based on step 1, registration, which will be separately for each state. Now few other points. If at all you are working in two states where there is a fight between two states, you are working in Tamil Nadu and Telangana. What is the limit? Tamil Nadu, Telangana, 40 and 20. You will resort to 20. So you are checking aggregate turnover will be 20 lakhs for both the states put together. So you are working in Telangana, Tripura. 2010. Who will win? 10 lakhs will win. So your aggregate turnover of both Telangana and Tripura should be less than 10 lakhs. If you are working in Tamil Nadu, Tripura, your limit now reduces to 10 lakhs. If there is a fight between 40 lakhs, 10 lakhs will win. The younger one, 10 lakhs will win. So your aggregate turnover means both the states turnover, Tamil Nadu and Tripura together should be less than 10 lakhs. But at times, it will go back to the higher limit. When you are working in two states where limit is higher limit versus lower limit, by default, which will limit? The lower limit will be the criteria for all the states put together. But at times, you will go back to the higher limit. When is that? When the lower limit state deals with only exempt supply or only non-taxable supply. Anyways, you are not going to get registered in that lower limit state because of section 23. You can go back to higher limit. So what is the by default condition? Whenever there is a fight between higher limit and lower limit, who is going to win? Lower limit. You are going to 40-20 means 20 lakhs. 20-10 means 10 lakhs. 40-10 means 10 lakhs. But there is an exception. What is that exception? When there is a fight between higher limit and lower limit, you might finally go back to higher limit. When is that criteria? If the lower limit state deals only and only with exempt supply or only and only with non-taxable supply. Only and only with exempt supply and only with non-taxable supply. Because anyways, it is not going to get any revenue. Anyways, there will be no registration in that state. So by default, this is a general thumb rule. This is a general rule. This is an exception. Thumb rule is high limit versus low limit. Low limit will be applied for all the states put together. At times, you will go back to high limit when the lower limit state deals only and only with exempt supply or only and only with non-taxable supply. So that is everything about your section 22 read along with 10 bar 2019 CT. There's a notification for this 40 lakhs. Now, as I said, what is more powerful than 22? 22, then it is more powerful is 24 and finally it is 23. Now we are going to see section 23 and 24 together. There are three situations where you will never ever get registration irrespective of your turnover. Section 23 will talk about no registration. 24 will talk about compulsory registration. If at all you are caught between 22 and 24, go with 24 compulsory. But if you are caught between 24 and 23, go with 23. No registration. There are three scenarios where you will never ever get any registration irrespective of your turnover. What are those three scenarios? Where you have supplies which is exclusively non-taxable supply, or you have supplies which is only and only exempt supply, or where you have supplies which is only and only supplies which is taxed under RCM. You are not the recipient. You are talking from the angle of supplier. You are not the recipient. You are talking from the angle of supplier. In these three cases, where it is only and only non-taxable supply, only and only exempt supply, only and only RCM supplies, you are not talking from the angle of recipient, you are talking from the angle of supplier in all these three cases. In these three cases, what will happen? You are not required to take any registration irrespective of your turnover. Your turnover may be 10 lakhs, 1 crore, 10 crore, 100 crore. no worries. No need of registration. But when is it possible? Only and only exempt supply, only and only non-taxable supply, only and only RCM supply from the angle of supplier, not from the angle of recipient. Recipient means compulsory. From the angle of, I am making all the supplies. I need not pay any GST. My recipients will pay under RCM. It is as good as no tax for me. No need to get registered. No need to get registered. Then there is a point which tells that agriculturalists, to the extent of supply of agricultural produce out of cultivation of land. Agriculturalist means what? Only and only individual and HUF. No one else, not agriculture company. Only and only individual and HUF. Agriculturalists to the extent of supply of produce out of cultivation of land. Now here they don't use the word exclusively. They use the word to the extent of. To the extent of. First thing, we are not talking about reseller of agricultural produce. We are talking about farmer, agriculturalist, who is actually cultivating the produce out of land and he is selling. Now, if at all, this agriculturalist turnover is 50 lakhs, 30 lakhs produce and 20 lakhs other supplies, he will get registered. Even after getting registration, on 30 lakhs, he will never pay GST. On this 30 lakhs, he will never pay GST. So this is more of no payment than of no registration. This is more of no payment than of no registration. So if you are talking about an agriculturalist who is having agricultural produce 30 lakhs and other supplies 20 lakhs, which means assume that this agriculturalist is in the state of Tamil Nadu. Has he crossed the registration limit? Yes. He has crossed the registration limit of 40 lakhs. Therefore, he is registered. Even after getting registration, assuming all the supplies are only of goods, that being the case, I have taken 40 lakhs. Even after getting registration, assume that agricultural produce is having 5%, other supplies having 18%. On this 30 lakhs, GST will not be paid by the agriculturalist, even though he is registered, even though there is a rate of tax on the agricultural produce. Obviously, he has to pay GST at 18% on other supplies. This is more of relaxation from payment than registration. So here you will understand the word extent of. To the extent of agriculture. Are we talking about a reseller? If the same person is a reseller, he will pay tax both on agricultural produce as well as on other supplies. We are talking about an agriculturalist. To the extent of supply of agricultural produce, he will not pay GST. Two important points. Though he is registered, though there is a rate of tax. Though he is registered, though there is a rate of tax, still he will not pay anything on this agricultural produce. So that is for your agriculturalist. Now, all the other points that you have are for other cases. Are you talking about compulsory registration? And at times 23 will help you. As we have seen 4 cases where you will never take registration. 3 where you will never take, and 1 where you will never pay. 3 where you will never take registration, 1 where you will never pay on a particular portion. Fully tax, non-taxable supply, fully exempt supply, fully RCM supply from the eyes of supplier, and agriculture to the extent of supply of agricultural produce which is out of cultivation of land. He might be registered, there may be a rate of tax on produce, but he will still not pay GST on the supply of agricultural produce. On other supplies, he will pay GST. Now, when you talk about RCM, you should also understand that what we have discussed was from the angle of supplier. What if you are talking about from the angle of recipient? From the angle of recipient has to take compulsory registration. From the angle of recipient has to take compulsory registration. Now we are entering 24, read along with 23, 24. We are entering 24 here and there we will be again seeing 23 relaxation. So you are talking about supplier only having supplies tax under RCM. I am the supplier. I am having all the supplies tax under RCM. I am never going to pay tax. I will never get registered. But my recipients have to take compulsory registration even if their turnover is less than 20, 40, 20 or 10 lakhs. So here recipient has to take this compulsory registration. But normally what will happen? There will be suppliers who will have partly taxable under FCM, partly taxable under RCM. They will not get the relaxation of no registration. They have to get registered, but they will not pay tax on the supply which is taxed under RCM. Recipient will pay tax after taking compulsory registration if it is not registered. If it is not registered. That is the first point. Now, other points on interstate outward supply. On interstate outward supply of goods or of services. Be it interstate supply of goods or of services, you have to take compulsory registration, but you have certain relaxations. Now, how to remember? If at all you are having interstate outward supply, interstate outward supply, we are not talking about intrastate, interstate outward supply of goods of services. So, what will be the normal answer for goods? The normal answer for goods will be you have to take compulsory registration under section 24. The normal answer for services will be, though by prima facie you are covered by compulsory registration under section 24, but section 23 gives you a relaxation and tells that you can go with turnover based registration. You can go with turnover based registration, but this time this turnover based registration relaxation is not given by section 22, it is given by section 23. Section 23. Why? The moment you have interstate supply, you don't see 22, you go to 23, you go to 24. Basically, section 24 tells us even if you have interstate supply of services, you have to take compulsory registration, but there is a relaxation given under section 23 for interstate supply of services. Interstate supply of, so this turnover based registration for services, turnover based registration means what? 20 lakhs or 10 lakhs is not by virtue of 22, it is by virtue of 23. Now there is an exception when you talk about goods. When you talk about goods, if you talk about notified handicraft goods, you talk about notified handicraft goods, even though there is interstate supply, even though there is interstate supply of goods, even then you can go with turnover based registration. This relaxation is again given by 23, it is not given by 22, and for goods turnover based registration means what? 40 lakhs, 20 lakhs or 10 lakhs depending on which state you are. For notified handicraft goods, you will still get the benefit of turnover based registration, that is 40 lakhs, 20 lakhs, 10 lakhs, but because of section 23, not 22. It was thrown outside 22, it went to 24, from 24 section 23 gave a relaxation for notified handicraft goods. Now what is the normal answer for services? Even though you have interstate supply of services, turnover based registration, but there is an exception when you are talking about job working sector for jewelry industry. Not other industry will come in general category. Job working sector for jewelry industry, you have to take compulsory registration under section 24. For goods by default, it is compulsory registration. For services, by exception, which is job worker for jewelry sector, that is compulsory registration. For goods, when you are talking about exception, notified handicraft goods, that is turnover based registration under 23, not by 22, because of 23, 40, 20, 10 lakhs as an exception. For services, generally there is turnover based registration because of 23 relaxation, 20 lakhs and 10 lakhs. It works in a very reverse manner. So that is for your interstate outward supply. If you have intrastate outward supply, don't worry, you're not even covered in 24. Forget about 23. You take the benefit of section 22, 40 lakhs, 20 lakhs, 10 lakhs. So when you talk about 40 lakhs and 20 lakhs, 10 lakhs, it is applicable only for your intra-state supply within the state. Now next compulsory registration is for your CTP and NRTP. CTP and NRTP. But for CTP, you have a relaxation. But for CTP, you have a relaxation. What relaxation you have for CTP? Same notified handicraft goods. Same notified handicraft goods. If you're dealing with notified handicraft goods, even though you're CTP, there is no need of compulsory registration. You can go with turnover based registration. So when you talk about your CTP and your NRTP, NRTP is very clear. There is always compulsory registration under section 24. CTP by default is always compulsory registration under section 24. At times, as an exception, when you're dealing with notified handicraft goods, they tell that, okay, you can go with turnover based registration as per section 23, which is nothing but 40 lakhs, 20 lakhs and 10 lakhs. Rather, both are interconnected when you talk about interstate supply of notified handicraft goods, turnover based registration, and casual duxel person for notified handicraft goods, turnover based registration. Turnover based registration. And for both of them, there is an additional criteria when you talk about notified handicraft goods, that though you are getting relaxation from registration, you should be a valid PAN card holder and there should be compulsory e-waybill. You are getting relaxation from registration, but we still want to track you. So there should be compulsory e-waybill. There should be compulsory, even unregistered person can generate e-waybill. There should be compulsory e-waybill. Now, other areas that you have, all the other areas that you have. First, let us take simple areas that you have. If you are required to deduct TDS, or if you are required to collect TCS, or if you are required to pay tax under section 9(5), or if you are required to distribute your credit ISD, or if you are an OIDRS from outside India to India, or if you are talking about a special agent, as per schedule 1, all of them compulsory registration, no exception. Who are they? You'll find them all in exception category. TDS deductor, TCS collector, ISD, OIDRS outside India. See, TDS, TCS, ISD, OIDRS from outside India, and ECO under section 9(5). ECO under section, because it is going to pay tax on behalf of both supplier and recipient. So these 5 categories, it is always compulsory registration. Right. So ECO under section, ECO is required to pay tax under section 9(5), compulsory. ECO who has to collect TCS, compulsory. ISD, TDS, compulsory. Rather, one more point we have left out. Schedule 1, special agent, compulsory. So these 6 categories, ISD, TDS, TCS, 9(5), OIDRS from outside India, special agent. Always they are required to take compulsory registration. Now, where is this relaxation? When we are talking about your supplier of goods or services through ECO other than 9(5) category, because 9(5) category you may be registered, you may not be registered based on your turnover. 9(5) is a different category where ECO will take the responsibility. Right? We have discussed passenger transportation, services, accommodation, housekeeping, and restaurant, where we have seen that at times, if it is passenger transportation services covered under 9(5), supply will never be registered. But if it is accommodation, housekeeping, he might have to get registered because he may not be covered under 9(5) always. 9(5) has got a condition that you should not be liable for registration under section 22. And when you're talking about restaurant, you may be registered, still partly it is under FCM, partly it is under 9(5). not RCM. 9.5 is not technically RCM. 9.5 is neither FCM nor RCM. Clear? So you are not talking about 9.5 case. Supplier of goods or services other than 9.5 category where ECO will collect TCS. So you are not talking about Amazon through whom you are supplying the goods. Amazon will take compulsory registration. Amazon will take compulsory registration. It has to collect TCS. It has to take compulsory registration. Amazon, no exception. Amazon has to take compulsory. But what about supplier of goods through Amazon? Or what about supplier of services through different online portals or websites? Now, supplier of goods through Amazon. Now, understand it this way. Understand this way. 9.5 section 9.5 is applicable. Section 9.5 is not applicable. Section 9.5 is applicable. Section 9.5 is not applicable. If section 9.5 is applicable, ECO will take compulsory registration. ECO will take compulsory registration. Supplier of 4 notified services, because 9.5 covers only 4 notified services. I am not writing an answer. I will write it depends. It depends. What you are, who you are, it depends. Case to case you have to decide. When 9.5 is not applicable, when section 9.5 is not applicable, there may be TCS, there may not be TCS, correct? TCS may not be there, TCS may be there. Because for TCS to be there, there are 2 conditions. Supply is through ECO and consideration is received through ECO. TCS may be there, TCS may not be there. If TCS is not there, if TCS is not there, ECO, supplier of goods who is supplying through ECO, supplier of service who is supplying through ECO, all of them have to take turnover based registration. No one is compelled. No one is compelled. Turnover based registration. But when TCS is applicable, ECO, you have to take compulsory registration. Section 24. Supplier of goods through ECO. You have to take compulsory registration. Section 24. Supplier of services through ECO. That person who is supplying the services through ECO. Now there's a relaxation for service sector, just like the normal relaxation you had in interstate outward supply. Turnover based registration, but because of section 23. Initially it is compulsory, but who's giving relaxation? 23. You'll find a difference. Here also I wrote turnover based registration, but this was because of section 22. This was because of section 22. So when you have this entire understanding, wherever 9.5 is applicable, don't worry, ECO will go for compulsory registration. Supplier of notified services, they may have to take registration, they may not have to take registration. It depends on each of the 4 cases. Prima facie, first category will never take registration, passenger transportation service. Second, third and fourth, they might have to take registration if their turnover is crossing 20 lakhs and 10 lakhs. Now, when you talk about 9.5 not being there, when 9.5 is not there, you have to ask another question, whether TCS is there or TCS is not there. If TCS is not there, life is very simple, whether it is ECO or supplier of goods or supplier of services, turnover based registration as per section 22. If TCS is there, then ECO compulsory registration. Supplier of goods through ECO, compulsory registration. But when you talk about supplier of services through ECO, it is turnover based registration, but because of section 23, not because of section 22. Not because of section 22, it is because of section 23. And whenever I tell turnover based registration for service sector, it is 20 lakhs or 10 lakhs. It is 20 lakhs or 10 lakhs. So that's everything about your liability to get registered. Section 22 read along with section 24, read along with section 23. You cannot crack an answer without linking all these 3 provisions. Now a small change when your supply is through ECO and when TCS is applicable. So supply is through ECO and your TCS is applicable. Normally what is the understanding is ECO has to take compulsory registration, supplier of goods, compulsory registration, supplier of services, turnover based registration. So ECO, it is compulsory registration section 24. Supplier of services, it is turnover based registration section 23, which is 20 lakhs or 10 lakhs. Please understand that's a change. Supplier of goods is also turnover based registration, which is 40 lakhs, 20 lakhs or 10 lakhs in terms of section 23. There's a notification 34/2023 which gives this benefit. The only difference between the two, when you talk about supplier of services, though TCS is applicable, supplier of goods can also take turnover based registration and supplier of services can also take turnover based registration. For service sector it is 20 lakhs and lakhs. For goods sector it is 40 lakhs, 20 lakhs and lakhs. Now the differences, please understand the differences here. So when you talk about turnover based registration, you always see only your current year turnover limit. But here in the goods sector case, very rare case where you will see the turnover of previous year and current year. Obviously previous year doesn't make sense, but here you're going to check first turnover of previous year should be up to 40, 20, 10 lakhs. Also turnover in current year should be up to 40, 20, 10 lakhs. That is the first difference. The second difference that you see here you can have intrastate or interstate outward supply for service sector. But when you talk about your goods sector, you can have only intrastate outward supply. Interstate outward supply you cannot have. So only intrastate is allowed, interstate outward supply is not allowed for goods sector. Even though you're supplying through ECO but TCS is applicable, you should not make interstate outward supply, you should have only intrastate outward supply. In service sector, there's no concept of enrollment number. Here in goods sector, you have the concept of your enrollment number. Before making such supplies, you should take enrollment number, which should be there only in one state throughout India, and only one enrollment number should be there in that state. So you can make supplies through ECO without any registration, but you have to take enrollment number, which is possible only one state throughout India. You cannot take multiple enrollment numbers in different states. Also, it should be only one enrollment number in that particular state. And once you cross the limit of 40, 20, 10 lakhs, you take registration, this enrollment number automatically will be invalid. So this is possible only after taking the concept of enrollment number. So you see three clear-cut differences. What are these three clear-cut differences? The first is when you talk about interstate outward supply for goods sector is not allowed, whereas here it is interstate outward supply is allowed. What are the three differences that you see between supply of goods through ECO where TCS is applicable? Both for goods sector as well as for service sector, you have turnover based registration differences. Goods sector turnover based registration is 40, 20, 10, and the service sector turnover based registration is 20 lakhs and 10 lakhs. The other difference is when you talk about service sector, obviously whenever you talk about turnover based registration, it's current year. But surprisingly here turnover based registration, first you have to check previous year up to 40, 20, 10, also current year 40, 20, 10. The second difference is when you talk about service sector, you can have interstate outward supply of services. For goods sector, you cannot have interstate outward supply of services. Even if you're taking this benefit, no interstate supply of outward supply of goods, no interstate outward supply of goods through ECO. Even though TCS is applicable, you can be unregistered but not making interstate outward supply of goods. In service sector, when you're not taking registration, obviously no registration, nothing, no enrollment number concept. But here they have the concept of compulsory enrollment number, which is possible only in one state throughout India. You cannot be dealing in other states through ECO where TCS is applicable. And in that state, only one enrollment number. And only after you get enrollment number, you can make supply through ECO where TCS is applicable. And once you cross the limit of 40, 20, 10 lakhs and you take registration, this enrollment number automatically will be invalid. So that is the change which you are seeing for your goods sector. And understand that when these people are unregistered, ECO will collect TCS. This is an additional point. ECO is going to collect TCS only if the supplier is registered. If the supplier is unregistered because of the reasons that we have discussed, supplier of goods unregistered, supplier of service unregistered, TCS will not be that though conceptually TCS is applicable, but finally TCS will be there only and only where the supplier who's supplying through ECO is registered. If the supplier who's supplying goods or services through ECO is unregistered, conceptually TCS may be there, but TCS will not be collected by ECO. Though that supply will be reported in written but not be collected. So that is a change which has come in your supplier of goods through ECO, where TCS is applicable. The no-base registration is still there even for supplier of goods. Special registration for CTP, NRTP, casual taxable person and non-resident taxable person. Casual taxable person and non-resident taxable person. When you talk about CTP, NRTP, everything is very special. Why? They are having temporary registration. They are having temporary registration. Let us discuss the difference point first. CTP will make a normal registration application. NRTP will make a special registration application. Because NRTP registration will be based on PAN of another person. PAN of another person who should be an Indian resident and be a valid PAN card holder. Also, NRTP will give its own proof. If NRTP is an individual, NRTP will give self-attested copy of passport. If NRTP is a company, it will give some identification number that it is having in its country. In India, we have corporate identification number CIN. Outside India, there will be some identification number that company is having outside India. So that its own proof also it will be giving. This is only peculiar for your NRTP. This will not be there for your CTP. Now, what is the concept of CTP and NRTP? Your CTP means you're there and working in Gujarat as a regular taxable person. You want to come to Tamil Nadu to participate in a business exhibition or a trade fair. Come, participate and leave. You don't have any place of business in Tamil Nadu. I'm discussing the definition as well. You don't have any place of business in that state, Tamil Nadu. So, Adani Limited, which is there in Gujarat, when it is coming to Tamil Nadu for business exhibition purposes, not having any presence in Tamil Nadu, no branches in Tamil Nadu, it is regular taxable person in Gujarat, but casual taxable person in Tamil Nadu. For Tamil Nadu, it is CTP. It will come, participate in business exhibition. When the business exhibition gets over, it will leave. It will leave. So, Adani Limited will have two GST number. In Gujarat, regular GST number. In Tamil Nadu, casual taxable person GST number. If in the same business exhibition, if you are inviting Trump to participate, who happens to be a non-resident, he is not having any presence across India, be it place of business or be it residence, he is not having any presence across India. And by the way, he is also coming for temporary purposes. He is not coming here permanently. He will come, participate and he will leave. He will leave. He is called as NRTP. He will be taking NRTP registration in Tamil Nadu. That NRTP registration is not valid for across India. NRTP state wise. He will take NRTP registration in Tamil Nadu. In Tamil Nadu. That registration will not have long validity. It will have a very short validity. Maximum validity will be 90 days. We will be discussing that. Now, what are the special points? Normally, when you are talking about a normal person, you have to apply for registration within 30 days when you are liable. But they have to make advance application. At least 5 days before the commencement of business, which means before the starting of business exhibition or trade fair. Advance application. Normally, after you are liable within 30 days. These people, advance application. Normally, if you apply on time within 30 days, your effective date of registration is date when you are liable. If you don't apply on time, date of grant. But for them, they can make taxable supplies only after grant of registration. Which means even though they might have applied 5 days before the business exhibition starts, but officer is taking time. Officer is taking say 15 days. Whether CTP and RTP applied 5 days before business exhibition? Yes. Assume that business exhibition started on 1st of April. CTP and RTP have applied 5 days before. They have applied on 20th of March, well in advance. But officer takes time and gives the registration on 5th of April. Did CTP and RTP applied in time? Yes, they applied 5 days before. They applied on 20th of March, which is more than 11 days. Correct. But officer gave registration only on 5th of April. From when they can participate in business exhibition? Only from 5th of April. Their effective date of registration will be only 5th of April. 5th of, very strict for them. Now, normally, when you take registration, whether you are required to make any deposits? No. You are not required to make any deposits. You are not required to make any deposits. But CTP, NRTP, Tamil Nadu government fears that they will run away. Adani will run away to Gujarat and Trump will run away back to USA. So it will be difficult to catch hold of them. So they take advance deposit in cash ledger, which is based on estimated net tax liability, not gross. At least to that extent they are logical. Estimated net tax liability, which means output tax minus input tax. Estimated. Why estimated? They are yet to start a business. So only estimation will be working out. So they have to make your advance tax and income tax is also estimation, right? Just like that, here you are going to pay advance tax based on your estimated net output tax liability. Normally, when you get your GST number, it is valid till it is cancelled. But CTP, NRTP, when they get their GST number, it is valid for maximum of 90 days or last date mentioned on the registration certificate, whichever is, what is the validity? Repeat that. 90 days from the date of grant of registration or last date mentioned on the register. Officer may write the last date. Officer may not give you permission for 90 days. Last date mentioned on the registration certificate, whichever is earlier. Whichever is maximum validity is 90 days. Not always. Officer can give you registration only for 35 days. Right. Can you extend your registration? Yes. Conditions for extending. If you are going to extend your registration, make sure that you have made application for extension before original validity gets over. Again pay advance tax on basis of estimated net output tax liability for the next period. In that case, it can be extended for another 90 days. Again, another 90 days is not clear-cut 90 days. Another 90 days from the original validity or last date on the extended registration certificate, whichever is earlier. Whichever is earlier. So, one time extension is possible. What are the criteria for extension? Apply for extension before the original validity gets over. Again pay advance tax and the extension will be valid for what? 90 days from the original validity or last date mentioned on the updated or extended registration certificate, whichever is earlier. And finally, can you extend second time? No. Extension is possible only once. If you're talking about second time extension, officer will tell, come, welcome to Tamil Nadu, get a branch, come for regular taxable person. Don't come as CTP and RTP, don't come as guest, be a person here. No CTP and RTP, come as a regular taxable person. Only second time, only first time extension is possible. Second time extension is not possible. Now, don't you think that once their registration is cancelled, they might have paid extra advance tax than their liability? There might be a possibility that advance tax that they have paid is more than their actual liability. Don't worry. Take the refund. Whatever balance is lying in your cash ledger, take the, in refund chapter, you will see that the criteria for them to take the refund is they should have filed all their returns. They should have filed all their returns. Take the refund. They should have filed all the returns. Take the refund of the excess amount which is lying in your electronic cash ledger. So that is all about your CTP and NRTP.